Oh, damn, that feels good. Are we Gucci? We're not. We're not. Oh, damn, that feels good. Okay, we're Gucci. Gucci. Where is the Discord? Thangy thang thang. Brat's got water. Damn. Damn. Should we call this Shorts Punched, right? Shorts Punched. Boom, 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 boom. Eating at a Mexican restaurant. Nice, I'm jealous. I'm looking no food. I just had my last meal. Running low until tomorrow. But yeah, I mean, in terms of yesterday's juice box to get caught up, right? You ended up getting the retest. So if you took this long, shout out to you. If you took like the initial short, whether you did this or the one later, you would have got break even, worst case. So shout out to the juice box, shout out to the math. Here's the open interest. Most of these shorts have like been closed out now. Like this huge spike we were talking about yesterday is like kind of came right back down on this move up. So we'll see, right? We'll see what starts happening from here. So far, like, it looks like they want to defend this level, yeah? Enchiladas. Mayata. What is that? What is that? Interesting. Making me hungry. Update our levels. Oh, shout out to Tesla, right? Is this thing finally gonna start going or what? Highest daily close ever. God damn. God damn. Feels good, right? Feels good. Yeah, probably not gonna be selling any. This is like a long-term hold, but the biggest position I have by far. Feels good. Max 7 lip flop coming. Maybe. I don't know about that. Not know about that. But we'll see. Oh yeah, the levels. The levels. Eight, 7, 8, 5, 2. 8, 6, 6, 7, 1. Where's this thing? Oh, what are the chances they all ended in a 0 today? What's the probability of that? Palladium is just going. Goddamn. Goddamn. Shout out to Palladium. You saw them looking so weak, right? Out of Mike Sui, basically. Everything else do. Also, like all the weed stocks had like another. I mean, they like sold off and then bounced back essentially. Like all of them have the same kind of thing going on today. So shout out to the weed stocks. Interesting. So let me lower this. I don't think I missed too much. Because I was looking at this most of the day today, so I don't think anything slipped our eye. Okay. Let's check out the order book. How's this book thangity thang looking? Interesting. Some of the orders in the spot order book that were lower like got pulled. One of them walked it up to 8,600. The other one just like canceled that shit. And the spoofer is back in the order book for futures. Okay. Interesting. How's Hyperliquid doing? Hyper liquidation. Hyper liquidation. What are we missing here? We're missing something. Oh yeah, the order flow. I left it open earlier already. Okay. Boom. Trying to find something to nerd out on. Mike Malone, yap, incoming. Damn, I'm hungry. I'm so goddamn hungry.
I think Bitcoin, the first stop is around 50,000. It would drop to zero. The first stop was around 50,000. I think it's going to 10,000. There's key reasons for that. When gold grabs alpha like it did this year, that's telling us something. That's a warning. And I'm heeding the warning. I'm fearful that we might have a bit of a crash in the stock market. All I know as a strategist is gold is way too stretched for me. Bitcoin's heading lower, so I'm pointing that out. Crude oil is heading lower, so I'm pointing that out. And to me, I'm just pointing out the risks of the correction in the stock market.
I'm very pleased to welcome back to the show fan favorite Mike Malone, senior commodity strategist at Bloomberg Intelligence. We'll be back and talking about the commodities outlook with Mike, but also his outlook for the macroeconomic landscape for 2026. Welcome back to the show, Mike. Good to see you.
David, it's good to be back. I always appreciate talking to you, and I appreciate the favorites from the fans. I appreciate your support.
I appreciate your support. It's our last discussion for 2025. Yeah. Looking forward to many more in 2026. But let's just start with a recap of this year. What surprised you the most with how markets performed, how the economy performed, how your forecasts panned out, and then we'll dive into what happens next for the new year.
The best thing, I think, as a trader, strategist, investors, to focus on what you got wrong the most first. And I was wrong. I've been wrong about this persistent rally in the stock market. I think it's about time we're going to get a pretty significant reversion next year in stock market, bond yields to go lower. But I've been wrong in those for a while. Bond yields ticking that way. So that's the number one thing I've been surprised about still. I was surprised at how high things like Bitcoin got.
We changed the audio. It should be good now, yeah? Question is the music. How loud was this? How loud was it? I can't tell. Gee. Seems pretty quiet. What about the YouTube video?
At what time we're going to get a pretty significant.
Seems a lot louder.
In stock market.
Interesting. Okay, we'll have to play with that at some point. BTC will never be below 70,000 ever again. We'll see. We'll see. We shall see.
Really, not, I wouldn't say happy, but expected those markets to turn lower, and they have. Expected crude oil to turn lower, and then they have continued lower. Expected gold to go higher. And the key thing I was mainly surprised about is I did not expect we get the best year for gold and silver since 1979. That just makes me absolutely frightened, and I should right away start out with the caution I'm expressing is I don't give investment advice, but there's certain times in your life you can help people. And I see a hurricane coming. I've never been told I can't say just overweight treasuries. So that's the feeling I'm getting right now.
There's a hurricane coming. We're going to find out what that means exactly and how we shelter from the storm. But I want to start by talking about monetary policy and the economy first before we get to your outlook on certain commodities and asset classes. Take a listen to what Jerome Powell had to say at the last FOMC conference. Take a look.
Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions.
So that was effective as of December 12th, I believe, so a few days ago. That sounds like, according to many strategists and economists, sounds like the beginning of a minor QE. And I'll just let you comment on whether or not it is actually QE per what you think and your colleagues think, and whether or not this changes your outlook for inflation.
No, I still think we're going to have pretty severe normal deflationary forces that follow the inflation. That's one thing I've been somewhat wrong about because the stock market's still up. But I think that's going to really kick in next year by things I'm seeing from crude oil collapsing and gold going up. What I heard from it's what he said versus what I heard. What I heard is that the analogy I heard in baseball sometimes in a good inning only starts with the walk. To me, now the U.S. Central Bank is starting to buy treasuries. I want to be on that trade. It was one of the key things I wanted to buy. I was bullish gold for too long until it finally broke out in 2024. As the central major deepest pockets of the planet were buying gold. Now the U.S. He's hinting at buying treasury. Now for normal reasons to cover flow and everything. But to me, it's just getting started. And all we need is just, God help us if the S&P 500 drops to its 200-day moving average, which is about 10%, which would be about almost 25% of GDP. It's going to happen. We're going to get that kind of force. We're going to have to start seeing some pretty severe easing, just similar to what's happening in China. And I think that's just what's going to be happening next year. And I say that, I'm emboldened to say that because of what shocked me this year. It was the best year ever for gold versus crude oil going down. That disparity around 90%. Was last match in 2008 at 60%. So to me, things like that are trying to, and the major shift we had from higher to lower in Bitcoin and cryptocurrencies, to me, this is peak stuff, major peak risk asset stuff that's just starting to kick in. And I think the Federal Reserve is just part of it. And the key lesson I like to learn is those of us who were trading back in 2000, 2001, and when the S&P dropped 50% after the Federal Reserve first started easing, and then when the S&P dropped 50% in 2007 after they first started easing, I see the potential we're going to be just doing that again and heading lower, and cryptos are leading the way. And I don't know what stops it right now, other than just the key thing is sometimes just prices get too high and you have to go down. The question is how far, and that's the key risk I'm worried about for next year. So for now, as we head towards the end of this year, it's only December 16th, we're near the last week of the year. I expect a potential crash in markets. I hate to say that, but it's just last year around this time, the last few weeks of the year, we dropped 5% in S&P 500, and that high lasted till about June. We've had rollovers in cryptos, they've rolled over. MicroStrategy leading the way. You look at things like Microsoft, complete double top heading lower. NVIDIA, almost perfect head and shoulders heading lower. I mean, this market's rolling over. It's de-risking. And I say, sometimes it's best to panic, take profits.
When you say markets, you mean stock markets and everything. Potentially crypto. Everything? Because I think you wrote a piece.
As we speak right now, crude oil just made a new low for the year at $55 a barrel. Natural gas was up at $5.50. It's collapsed on the $3.90. It was up 40% in the year. Now it's up only 7%. The grains are rolling over. Soybeans are rolling over. The number one leading tip of the iceberg for everything is MicroStrategy. Now it's dropped almost 70. Well, it's dropped on this year 60% on a one-year basis. And a key pillar for everything is the U.S. stock market, David. And I think what we're finding is people are realizing like they did in cryptos, and maybe we should just start.
As a moron.
You already know why people hold gold. It's because it's real money. But what if your gold could do more than just sit in a vault?
Isn't this guy like one of the head financial analysts at Bloomberg? Senior commodity strategist at Bloomberg? I'd be that stupid.
Well, that's where our sponsor today, Monetary Metals, comes in. They offer a way for you to earn a yield on your gold paid in physical gold through their leasing marks. Thousands of clients already earn here. Put your gold to work soon. So we're not going to have inflation or massive reinflation because of monetary easing, like you just said. You're still sticking to your deflation camp. It's interesting how you don't think asset prices will benefit from easing, though. What are the forces that are so strong that are going to prevent asset prices from following the Fed's wind, so to speak? You know the old adage, don't fight the Fed.
Yeah, I love that old adage. Martin Zweig was a key prominent key person who liked to speak about that one a lot, but I just gave you two examples when peaks also often happens when the Fed starts easing. Now, this is kind of a restart of easing because it started easing. The easing started really a year ago in 2024. But now I think it's just the simple fact is you go too far, too high, and you just start reverting. Like I said, the key leading indicator for all this has been cryptos. They've rolled over, Bitcoin's rolled over, and it's just gone up too far. So the fact is this year's peak, maybe still about now, is 2.3 times GDP, stock market cap to GDP. Now, that might not, people can push back and then say it's financial, it's a financial market. But if you just look at the U.S. stock market versus the rest of the world, we peaked near 2/3, and that's starting to roll over. So to me, this is the beginning of a normal correction. We haven't had a down year in S&P 500 total returns. Only had 2 since 2008. We're overdue for that. All the signs are there for me. And that's like, and what emboldens me is what's happened with things like precious metals taking off and crude oil collapsing. And then I look at right now, as we speak, David, 120-day volatility in S&P 500 is about 11%. If we end the year here, that'll be the lowest since 2009. I said that about natural gas a few weeks ago. If we end the year here at 550, it'll be the highest since 2009, and it just reverted. So what we're talking about now is normal reversion. The Fed doesn't matter. In fact, today, as we speak in December 16th, we just had a dump of all the data, and it didn't matter. Market's already down almost a full percent, the S&P 500. Why? Because people are just waiting for a trigger to move, and that move is sell.
Well, let's take a look at your piece here that you published this week. It's called Metals Inflation versus Energy Deflation. We haven't talked about metals yet, but your title is, or subtitle is Gold 5,000, Crude 40, US dollar, a $2 US natural gas. These are 2026 tracks. Tell us about momentum could carry gold toward 5,000 an ounce. So I think gold is so far, up until our discussion, which is 10 minutes in, so far the only asset that you're not very bearish on yet. We've talked about deflation. We talked about stock markets. We're going to get to cryptos in a second, but $5,000 an ounce sounds great for this track for gold.
So when gold gets this stress historically, I've shifted from being a fundamentally bullish gold strategist. And the key thing is I had to take the pain. 21, 22, 23. I kept saying it's going above 2,000. I was the idiot. I got thrown down the mat and finally broke up higher. So that was the time to be accumulating and getting long in bullish gold. But now that's popped up to, some say 3 standard deviations versus a 60-month moving average. I like to say it's just the most stretch versus most moving averages. I'll use 60-month as one. Since the late 70s, early 80s, I switch over to my risk management hat, and I don't care about the fundamentals in these levels. Honestly, as now a risk manager, this is not the level to get overweight long gold. Historically, it proves it could get to 5,000 or it can get to 4,000. Now, right now, the momentum's up. It's going to continue up. But if and or when we get this normal correction in risk assets, everything is going to go down. That's what happened in 2008. So also, I want to give a little example of gold's companion, silver. Silver this year has had its best year since 1979. It's up over 20%, and now they're somewhat linked. Now, that's one thing I was really surprised by is how much silver's caught up versus gold. But the key thing to remember is in 1979, silver ended the year $32 an ounce. It was up 400% this year, or that year. This year's low was $28 an ounce. So you had about 50 years of nothingness. Yeah, you get pops. But that's the key thing to remember about things like commodities like this. When they pop this much, history proves you're not supposed to go out of your way to be overweight long gold or silver at these levels. And that's why I said at the beginning, I tilt over to anything that's kind of risk off, and gold is typically risk up. But when it goes this far, just be careful, and that's why I tilt over to treasuries.
But okay, so let me just summarize your view on gold in maybe a few sentences. So you're cautious on gold, given how far it's run, understandable, but you still think $5,000 in the cards. So that's still about a 20% upside. Help us understand how exactly you're positioned then, how one should be positioned, given your sentiment.
They can position any way you want. I'm a strategist, and I have to caution that the key fact I like to use is overweight long gold or new long gold positions. History does not prove they do well from such stretched levels. Fact. Just maybe it's changed this time. So here's a key thing. I just put gold and the word frightening in the same sentence for the same reason, because it's never moved at this velocity, David, ever. This far stretch, like 85% above a 60-month moving average with 120-day or stock market volatility this low. So my indication is gold's telling me stock market volatility is going to go up, and it usually means stock market prices go down.
And the other thing is it's never actually consolidated around a local top for this long. So take a look at how gold's been performing over the last couple of months. We can see clearly that it's been hovering around $4,200, $4,300 without moving in either direction dramatically. And so that kind of is a consolidated pattern. So if it wanted to go higher, it would have done so already weeks ago. It hasn't. And so last time it's done that, 2011 and also 1980, it hasn't stayed around its top and consolidated for very long before it's gone down. By the order of 2011 and 2012, it was 45%. It was even more, I think, 1980, it was 60%. And so what's stopping it from doing the same thing this time?
So it's the essence I learned in the business sometimes the hard way is never be shy about taking profits.
Yeah.
Just question how much. And the key thing is also this selling when they're yelling mantra. That was what really triggered me about cryptos last year. I said I wanted to be selling because they're yelling, and I'm getting that same feeling in gold. Now, the little difference is I'm more willing as a strategist to be short cryptos, a broad crypto market, because I think a lot of them are going to go to zero. But being short gold's another story. Just, if you've been overweight long and been bullish like me, it's just the essence of a strategist when I can get something right to be able to say, it never hurts to take some profits.
So let's move on to the US 10-year now. You're bullish on Treasury, so you think yields are going to come down. Is that because of QE and deflation, all of the above?
The number one force for U.S. Treasury yields to go down is the stock market going down. That's the 10. Everything else is maybe a 5 or less, because we are in a severe inflationary, excessive risk asset wealth creation mode, and it's just started to tilt the other way. You've seen that cryptos, all that wealth creation in cryptos, all that speculation is tilting lower. I think stock market's going to do the same. I think next year is going to be a down year for the total return. I don't know how much, maybe reverting towards 5,000, S&P 500. Not a big deal to say it, but it's kind of low this year. And that is the number one force for everything. That's the key thing is when you get to this stretch versus GDP, the stock market is the economy. And to me, that's the number one. So I look at a long Treasury, long bond position effectively is similar to a stock market put right now. The thing is you're still getting that. In the Treasury bond, you're getting almost 5%, 4.8%. And 10, 4.15%. And I've been saying it for a while, but I've been wrong. I think it's going to happen next year. So I think we're going to head towards that 10-year note yield in China, which is 1.85%. Currently in the U.S. is about 4.15%.
What do you make of interest rate differentials around the world where other central banks are potentially hiking rates? So Bank of Japan, for example, maybe Bank of England, Bank of Canada has actually halted the rate, a rate cut at a recent decision we're expected to. So we're certainly looking at central banks just not following the U.S. Fed when it comes to rate decisions. Term premiums may be a different story, but it doesn't look like they're following each other right now. How is that going to impact FX and rates?
Well, there you go. So part of that's part of a pressure factor on the dollar. I think the number one pressure factor is what lifted the dollar up is going the other way, stock market going down. But Japan is not significant, partly because they're coming out of a 35-year deflationary period. I remember you're talking to someone who, I've seen this before, traded JGBs, Japanese government bonds in the 90s, and I've seen it before. Now, the most significant, I think, market to look like, you mentioned UK, not as big as important. It's kind of hovering, but Germany's been stagnant in their economy for almost 5 years now. And the number one is China. So the bond yield in China, 1.85%. We've had almost 37 straight months of negative PPI. That's despite significant fiscal and monetary stimulus. The money supply is running $45 to $50 trillion, which is like double the U.S. And stock market and debt to GDP is running around 300%. That's much higher than the U.S. and much higher than Japan. So they're doing everything they can to help push back on that deflationary forces from the housing bubble and the emerging market that just shot up too fast. And now the whole rest of the world's their dependence on exporting to U.S. is being shut off. So that's part of the reason crude oil is collapsing and gold's going up. But the key thing is all what it matters for next year. So to me, again, the number one force for everything, for any central bank on the planet to ease, more so than any time in history, is a U.S. stock market. If it goes down and the U.S. economy shuts down and we get a little recession, they're all going to be easing. It's just the way it's going to happen. Where's Japan going to export to? Where's everybody else going to export to? This is all going that way. The key thing is we're at that extreme, and all the signs are there. That's why I say sometimes it's nice to just lock in that 4% in treasuries, maybe a little less now.
Let's talk about Bitcoin now. Bitcoin has had not a great couple of months, and you were on the show a couple of months ago calling for Bitcoin to potentially lose a zero in the next bear market. Now, this next bear market, hasn't lost a zero yet, but is this the beginning of the next bear market? Is that what this looks like?
Yes. To me, when you have a key theme that kind of gets thrown down on a mat, then comes back a little bit, you have to revisit. And that to me is Bitcoin put in a significant, cryptos put in a significant peak in 2024. There was good reasons for that. I don't have to mention them all, but the final one was President Trump getting elected on the back of tilting over from a zealot to a convert on cryptos. And then we had all this massive speculative excesses. And now I think Bitcoin, the first stop is around 50,000. You look at it the last 5 years, it's been hovering each year. It's touched around 50,000. And by the way, I made the same call in 2018. It would drop to zero. I was 70% right. Some people say 30% wrong. From around 10,000 went to 3,000. So I do think the first stop was around 50,000. I think it's going to 10,000. There's key reasons for that. First, the world changed. Now what's different now is no longer buying any kind of cryptos is no longer independent of most governments. Now you're dependent upon the U.S. government, and you're also supporting Trump, the Trump family.
That would be one hell of a bear market, but it is possible, right? It is possible. Especially now that strategies that come out and essentially said if they would sell if needed. That would be one hell of a fucking unwind. And everyone is talking about this 70K level, right? So, what usually happens when that happens? And not getting respected, right? that would shake a lot of people out too, right? Imagine the opportunity to be able to buy down here again. Oh my god. I mean, I'm sure whale's mouth would be watering at that thought. Just sell their bags up here like 120,000 and then load right the fuck back up at 50. Oh my god. That would be juice.
Are all invested in this space. And the key thing is, back when I got really bullish, I went to see Michael Saylor last night in an event. When I was really bullish in 2020, as was he jumped on board when it was around 10,000. Yeah, I called for a 10x. Now everybody's bullish. He's doubling down with the 10x, and I think it's just going to rotate back down. The difference is the bottom line fact is, and people can dispute this as much as they want, there is about 28 million cryptocurrencies on coinmarketcap.com. There's an unlimited supply of, you call them companions, and there was one in 2009, 2000, and that was Bitcoin. I look at precious metals, there's one.
I mean, yeah, they're all going to zero basically, right? Like 99% of these coins are just like vaporware.
You can't really create more of those.
No arguing
but
that.
in cryptos, there's unlimited supply. And key lesson to learn commodities is embrace the technology, but not the price. And the key thing about the technology in this space is, sure, there's a lot of equities are doing well, but they can create more with less everyday cryptocurrencies. And Bitcoin has the advantage of being one, but I do think it's going to head back to 10,000 and just see how that works out next year. And that also is on the back of the stock market dropping and yields dropping next year.
Well, you can't change the hard cap on Bitcoin. So maybe in the world of infinite printing of new cryptos, Bitcoin stands out as the dominant currency, perhaps. And let's just take a look at what happens if we do Bitcoin dominance. Perhaps Bitcoin dominance goes up. What do you think?
Oh, sure. Oh, completely. It's just some of these silly things that are, I love to look at Dogecoin and Shiba Inu. Dogecoin peaked at $60 billion last year. It tracks nothing. It was launched as a joke. And right now it's about 20 billion. Same with Shiba Inu. It's a joke. It peaked at about 20 billion last year. And right now it's about 4 billion. I think they're going to zero. That's not a profound thing. A lot of crypto people think the same thing. A lot of crypto people hope that stuff will get flushed out. And then we can reset the whole market. The big area why I have a difference is a lot of them tell me that Bitcoin is not correlated. And I point out they're all correlated. I just look at the market vectors small cap index. Its correlation with Bitcoin on 48-month basis is 0.84. Now that in the past was a lot less, but they're all linked. They're all going down. I think it's just started. We need some kind of trigger for it to end. And I think right now it's going to accelerate when the U.S. stock market backs up a little. Just a little move back to the 200-day moving average in S&P 500, which is right around 6,200, would be the first sign of, I think, a dip to buy in cryptos. Also, a key thing is we have the VIX. The VIX is buried at 17. Anytime the VIX pops around, when it popped around 60 early in the year, that was the time to buy cryptos. And when it popped around 26 just a few weeks ago, that was the time to buy cryptos. But that and volatility indications it's been one of the key market indicators I've ever had is volatility in stock markets way too low to be considering adding to new longs and risk assets. And cryptos are the riskiest of them. And then let's look at some of the key leading indicators. MicroStrategy. MicroStrategy was a key leading indicator on the way up last year, and it's already tilted lower. You have the 200-day moving average and Bitcoin rolling over, MicroStrategy rolling over. You see the trends there? The next one is the 200-day moving.
It's so based on like literally everything. There's a lot of people that think this. I mean, it has to be, right? Like, not everyone in the market thinks the same. There wouldn't be a market if everyone had the same ideas. So somebody's got to take the other side of the trade. Doesn't mean we should ignore them. Because we have just finished like a multi-year bull market. Well, I won't say finished, I don't know if it's done, but we're in the later stages of like a multi-year bull market. You're gonna have to correct at some point. It's gonna go up forever.
Moving average in S&P 500 to roll over. What stops that? I don't know. I think the risks are they all follow cryptos.
And cryptos all follow Bitcoin, and Bitcoin follows stocks. Is that the thesis here?
Well, in this case, it's leading. And I think it's leading because it's peaked. We've had a classic, David was one of the classic signs of a peak. Everything that happened in 2024, the halving, the ETFs, stock market record high, and certainly Mr. Trump flipping over are all reasons for it to have peaked. But also it's just the fact that the rollover factor and the pile on in ETFs. There's some of that's been the OGs switching out to more safer rather than have to worry about their keys and going to ETFs, but into poor performance. I mean, the performance of the all broad crypto market and Bitcoin has been horrible for over a year now. High volatility, poor performance, and people say, that's your typical risk managers looking at this and say, no, sorry, thank you. Yeah, it's had a great run before it got launched in ETFs in the mainstream, but now it's in mainstream. We all know the rule of the back test. The back test was great, but now it's time to perform. It's over, I think. And I'm here to express my views. And my view is the crypto rally is over. For now, it's people call it crypto winter. I do love some of the nomenclature. It's just a question of how far it goes, and we'd love to see signals for it to end. But to me, it's barely started because like I said, the stock market still just needs a little correction to just cleanse some of the excesses initially. Y'all know what the first say is, it's a healthy correction. We haven't even had that yet.
Some people say Bitcoin is digital gold. You're clearly not in that camp, given that you think gold's going to 5,000, even though you're consciously optimistic on gold, and you're not at all optimistic on Bitcoin right now. So diverging paths, they can't be the same type of asset if they're diverging in outlook, right?
I mean,
So,
things are
Digital Gold by
pretty
Nathaniel
strong
Popper,
bear case to be made in the market, right? Like first, like I mean, let's just look at what's happening. It started with like Palantir, right? Palantir earnings, massive sell-off ever since. Nvidia earnings, massive sell-off, hasn't recovered. Like all like large techs like rolling over. And this is supposed to be like the narrative, right? Isn't this supposed to be pushing the market forwards? The whole AI narrative. Then we got like a liquidity injection at the Fed meeting, and market sold off. So it's like we're getting like the most bullish news possible, yet we're rolling over. The market's not reacting to it. It's like this pretty big warning flag. Something's not right now. Labor market's like getting fucked. And the thing with the labor market is like, if you believe in this AI narrative, then that makes it even worse, right? Because if this AI narrative takes off, there's not going to be job creation. It's going to be massive job destruction. And now look what's happening with OpenAI. Google is releasing a free version of their AI tools, and all this investment into OpenAI is now just in a fucking hanging open in the air. Like, what the fuck? How are they going to get any revenue if their competitor is going on a free-to-use model that's equally as good or better? People just essentially incinerated their money with OpenAI potentially. Now you're starting to see stories come out about Oracle potentially like delaying AI build-outs. Credit default swaps on Oracle are like spiking like crazy. Usually where there's smoke, there's fire. I know nothing's guaranteed, but like things are not like rosy, right? We're not in some like Goldilocks bull market. Just, and this is all happening after, like, look at these charts, right? This is all happening after all these ridiculous parabolic blow off moves. So definitely a pretty strong bear case to be made. But we'll see, right? The day, who knows? One really strong bullish narrative comes out, gives like the market life. Because fucking bears think they're shorting down, so they're shorting everything. They're making money, right? So being bullish or bearish does not matter. So are you making money or not? Hey, for sure, all these stocks right now, you're literally sitting here printing money. And not only that, but it's hedges. A lot of times it's just simply hedging. If a bull market wants to resume, fucking prove it. Get back to the highs, and then they'll close out their shorts. Gotta prove it, right? Gotta make everybody a believer.
Who's now at Bloomberg, was one of the first books I really dug into in 2017 in cryptos. And I was obviously very bullish. I waited till 2019 to get bullish, around 5,000. But yeah, I love that, but it's not. Like I said, so here's the key difference. There's gold, silver, platinum, and palladium. There's gold and then 3 other precious metals. There's Bitcoin and then 28 million companions. It's just the difference is it was the first cryptocurrency. Now there's millions. And I think sometimes it trades more like leveraged stock market. Sometimes it trades like gold. And now I think it's trading like a highly speculative digital asset that's going to just reverting back to a lower price cure, and I don't think it's anywhere near that right now as we speak, around 87,000.
Anything you're bullish on for 2026?
Treasury bonds. I think treasury bond prices will be.
I was like, well, where's the 200 weekly moving average on this stuff? Pretty common, right? Like 200 weekly moving average in the bear market reconnected. 200 weekly moving average in the bear market reconnected. 200 weekly moving average got blown through. So this is at 56 right now. Obviously, it'll come up week over week, but that's like 60K, like low 60s. Not unreasonable at all, right? Not unreasonable one bit. Just watch. These bears are gonna get trapped. Then we'll have a blow off top. Then January, February next year, 10% correction. That's possible. It's possible. It's one of many things. Maybe they don't, right? Maybe they don't. Bullish on T-bills.
That's the problem.
I mean, in terms of like managing a portfolio, probably not a terrible idea, given the state of things. So it's not like he's going all in, putting all of his money just in T-bills. Probably just saying it's worth reallocating your portfolio to have like a bigger slice of the pie in there, given the current state of risk.
So here's the way I look at it. And admitted, I have to admit some of my weaknesses. I have not been a fan of the stock market for too long, but I found some great alpha and pointed out great alpha in Bitcoin and gold. Now, I jumped off the Bitcoin horse last year. And to me, that alpha was over, and it's proving strong this year. And I'm jumping off the gold alpha this year. And it's a key thing that really scares me about this year, David, is when gold grabs alpha like it did this year. I mean, there's nothing except just a few small peripheral assets that are outperforming gold, particularly on a risk-adjusted basis this year. That's telling us something. That's a warning, and I'm heeding the warning. And that's why I say you're supposed to just shift
This
over
stuff is hard to judge, right? Because like, okay, like what he's saying is true, but also like China's never been hoarding gold the way they have, right? Given like the whole BRICS situation and like, the US sanctions on Russia. Like that's quite an important factor to be considering. The thing is, it's hard. It's also hard to gauge, right? Because we don't know, like, not just one participant of many in the market.
Risk off assets like treasuries. To me, that's the bias for next year, and I'm fearful that we might have a bit of a crash in the market, stock market.
I mean, what are we looking at? 30%, 50%? What's a crash for you? 25% is a crash, technically.
It's the term that people use. Let's use 1987 as an example. The S&P 500 ended up the year with 2% gain. Most people don't remember it that way, but just a normal reversion. We'll see. Maybe gold and the S&P 500 meet at 5,000. I don't know for sure, but all I know as a strategist is gold.
SPX. That's not even that crazy, right? That's not crazy at all. Just back testing this level. Happens pretty often on these like larger shelves. Like here we back tested it. Here we back tested it. Like all of these are all back tested the same thing. The hell just happened? Boom, 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 boom. Well, if anything, like you should be looking forward to that, right? But this is the best time to be buying. Like those are the golden opportunities, right? You have to be patient for years and years and years to get those. If you miss the bear market, you're salty as fuck. You are salty as fuck. Because now you gotta wait years and years and years to get back in again with like amazing positions. I hope we got a fucking bear market, honestly.
Gold is way too stretched for me to be recommending, be putting out my very bullish comments that I did forever. And Bitcoin's heading lower, so I'm pointing that out. Crude oil is heading lower, so I'm pointing that out. And to me, I'm just pointing out.
Part of the reason why I've been watching these swing trader videos.
In the stock market. That's what people call it. We'll just get back to that.
To see how these people trade like the bottom of like high time frame cycles. Because whenever the bull market comes around, we're gonna be fucking prepared, right? Hella prepared. This chart got fucked up. How did this happen? Boom, 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 boom.
Remembers what's happening with the macro big picture. This is the most expensive stock market in history versus GDP versus the rest of the world versus housing and things like that. And maybe it has a worthy reason to back up now, and that is we do have a president who says he's going to make the world great, but it's kind of hard to get much greater than the valuation of the stock market. And this was a theme I had a year ago before the election of President Trump. My thought was whoever was the next president was going to have the misfortune of being the wrong side of the cycle, like President Hoover. This is just how expensive the stock market is, and they keep trying to pump it up. But what's happening by pumping up the stock market and talking up risk assets and pushing back on the Fed and creating tariffs? It's all elevating inflation, which means incumbents do not get elected. That's
Mike?
everyone's. Go ahead.
Yeah, no, I was just going to say that's great insight. Let's leave it here, and I know you have to go, so we'll end it here for today. But thank you very much for your time today, Mike. Not just today, but for the entire year. We appreciate you contributing to the show. Where can we follow you?
On your show, David. I'm looking forward to coming back next time. Who knows, a couple of months from now, we'll see how these calls work out. I'm on Twitter. I guess I can say Twitter now. Elon Musk has asked that question if we should call Twitter at Mike McGowan11 and LinkedIn, senior commodity strategist. And people who can reach out to me, I'm happy to add them to my distribution list. And again, David, thank you for having me on, and a happy new year and good seasonal greetings to everyone.
Yep, happy New Year and Merry Christmas and happy holidays to everybody. And
New
to you as well,
Year and
Mike.
a Merry Christmas. Boom, 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 boom. Yeah, bear market would be amazing, right? Like Tesla right now, like, am I gonna say I would love to have more. Like, I already have like a huge Tesla bag. Would I love to have more? Yeah. Am I gonna buy it here? Probably not. Maybe like a potential breakout trade and try and catch some momentum. But even then, a little late for that. Boom, 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 boom. Should we watch a bullish video to cheer you up? Well, I will say though about this guy's channel. Oh, a lot of bears are on here, right? A lot of bears. A lot of bears, essentially. Bearish people.
So we had a good.
That's good though, right? It's good. We need to keep all these things in mind because they do bring up a lot of valid points, right? If you just kind of go on ignoring them, you don't want to get blindsided on like a sell-off.
Correction, a good bear market ended on April 8th. Between April 4th and August 13th, quite a number, probably more than 50 separate buy signals. We cannot at this time consider the gains off the November 20 low as anything more than an oversold bounce of little technical significance for the intermediate term.
So I think investors right now are just looking forward to your guidance. We're looking for your guidance on what to do exactly.
Well, obviously, they're easy.
It's my pleasure to welcome back to the show Milton Berg. He's the founder of MB Advisors. Milton's been working on a proprietary market model for quite some time, many years he's told me, and now he's finally ready to launch it, use it, and share with us how it works. And we'll be getting his outlook based on his model. We'll talk about how the Fed has impacted markets or may impact markets. We'll talk about any other macroeconomic drivers that Milton thinks are important. Welcome back to the show, Milton. Good to see you as always.
Good to see you, David.
I'm very happy. Yeah, thank you. Thank you. Good to see you. I'm very happy to be able to share with my audience this proprietary model you've been working on. We're going to talk about that. I want to start by talking about what happened yesterday at the Federal Reserve Open Market Committee meeting, and we'll talk about their decision. So here is an article that highlights one of the key decisions that they've made. They will start reserve management treasury bill buying.
Free brain twits. Yeah, I mean, I don't know. That Michael Burry guy, I mean, I don't really follow him particularly closely. But he does have some like valid points about some things. But also some things he's like not expertly informed on. Like this whole thing about chips having like a 1 to 2 year lifespan before they're useless was like not true. Well, like a lot of other things he was saying like are pretty valid.
Said it would start buying short-dated government bonds to help manage market liquidity levels to ensure the central bank retains.
I don't know who this
firm
guy is
control
though. Like that guy I knew who he was beforehand. I have no clue who this guy is. And if he's gonna just sit here shilling his indicator, can't say I really care to watch this. Let's see what the summary tells us. Interesting.
over its interest rate target system.
What about the rest of the video? It ends at 38 minutes. It was an hour long. Bunch of ex crypto bros short in the market every day. that's always the case. Boom, boom. That's how the market works. It's not just an up only from eternity. And if anything, you want to be, if you do want it to be bullish in the near term, you probably better see a correction now, right? Because if we get a blow off top and another leg up, that's going to be a major correction can come in. You don't want to be seeing blow off tops. No, this one's gonna be funny. Let's watch this.
David, and I don't guarantee much. I will guarantee you, David, and I don't guarantee much, that the gold market in the next 10 years will fall by 30% or more at least twice. It may fall by 50%.
Which is to say
I think
that
a reckoning is coming in the energy market.
Yeah.
I think a reckoning is coming in the industrial materials market.
Give us one or two of these things that make it go to $5,000, $10,000. What happens to the rest of the world? It's always a pleasure to welcome back fan favorite, regular on the program, Rick Rule, proprietor of Rule Investments Media, co-founder of Battle Bank, former president and CEO of Sprott U.S. Holdings. Welcome back, Rick. We have a lot to talk about. Today is the FOMC meeting. We're speaking right before the FOMC decision, though, so by the time this airs, the Fed would have already made their decision. So we'll talk about what's next for monetary policy.
It's pretty massive, isn't
why
it?
you
That's
decided to
problem.
taper off your holdings on junior mining stocks. And finally, you will give us a rating or help us rate junior mining stocks, and you'll tell us how. So stay tuned till the end of the interview for that. Welcome back to the show, Rick. Good to see you.
Thank you for having me back, David.
The fact that the Fed is projected to cut their interest rate, Fed funds rate, by 25 basis points, while at the same time the Bank of Canada is expected to hold steady, while the Bank of Japan is expected to raise, and perhaps the European Union, the ECB is might be raising again, that signals a huge policy divergence, especially considering that Kevin Hassett, whom many people believe will replace Fed Chair Powell next year, is expected to be a lot more dovish. This policy divergence of the U.S. interest rate going down, while the rest of the world, the big central banks around the world, staying flat, if not going up, does that mean the dollar is going to weaken a lot more?
Yes. In fact, I believe, as we've discussed before, David, that the dollar loses 75% of its purchasing power over 10 years. By the way, I think the dollar will do relatively well over 10 years compared to those other currencies. And I think the policy decisions that you ascribe to the other central banks has to do with the fact that they can't get away with what the U.S. believes it can get away with. if they didn't raise their interest rates, given the sluggishness of their economies, I think it's likely that they would hold a bond auction that nobody came to. In other words, I don't think that's a voluntary decision on their point of view. I think the United States is making a major mistake. What the United States society is signaling to savers and investors on a global basis is that we don't care about the integrity of the US dollar. We don't care about its purchasing power. We are politicizing the dollar and politicizing the interest rate. As you and I have discussed, interest rate cuts are a subsidy to spenders from savers. Spenders, sadly, in a democracy are more numerous than savers. And so this is really all about that old joke about four coyotes and a lamb discussing the lunch menu. In this case, America's savers are on the lunch menu.
Fair enough. Then the fact that the underlying assumption here is that Americans even have the ability to spend. So you're upbeat about the economy then, Rick? You're upbeat
not.
about the. Oh, I'm sorry.
I am not.
Go ahead.
We have an okay economy, but we have a political class, and frankly, a political culture that ignores the economy and cares about politics. Don't get me wrong. We don't have a bad economy, but we have structural weakness. We have millions of Americans who don't have sufficient education to generate enough utility and employment that their employers can pay them sufficiently to live a middle-class lifestyle. That's a big problem. We're 30 years late addressing it. But I don't think the interest rate cut is about that. I think the interest rate cut is all about subsidizing middle-class spenders at the expense of middle-class savers. It is also about, frankly, making the government's budget debt in the near term more affordable. But what is really doing in the face of what is not a bad economy, not a great economy, not a bad economy, what it really signals is the abandonment of any concern on the part of the American citizenry in the integrity of the US dollar.
Well, let's give some practical, I guess, investment directions here. Well, not directors, but just let's just take what you're doing with your own holdings, and then we can learn from that. So, if I'm led to believe correctly, Rick, you've sold some of your junior mining and resource stocks recently. Tell us why, and second part of the question, tell us whether or not the Fed decision to cut rates further into 2026, and of course the end of quantitative tightening that already started this month in December, more liquidity in the system, would that incentivize you to buy back some of these stocks?
In a word, no. I began to anticipate the cycle that we're in 2022. And a lot of the actions that other folks are beginning to take now, I took a long time ago. Specifically, I have I own no bonds with a duration longer than 2 years. The deterioration of the purchasing power and the artificially low interest rates means that the bond portfolio that I maintained in the 1990s is a dinosaur. It's gone. I was surprised by the strength in the juniors this year. It usually takes a precious metals bull market longer to come down to the juniors. And when the financing window was open, the juniors stormed through it. When a company issues stock, they are telling you that they believe that your money is worth more than their paper. That's why they're trading their paper for your money. And the fact that virtually the whole junior industry was willing to do that told me what the insiders thought about the relationship of price to value in the junior industry. I have also been a very, very, very large investor in the junior space since 2020. I mean, a reasonable investor in the space for 25 years, but a much more aggressive investor in the period 2000 to 2022. And I was able to sell 25% of my junior holdings, recoup all of the capital that I invested in the space since 2020, and pay the capital gains tax on the disposition. So by selling 25% of my upside, I eliminated my downside, which for a 72-year-old is a very good trade. And I should tell you, I didn't exit the space. I took half the proceeds and I bought a package of gold, Franco-Nevada, Wheaton Precious, and Agnico Eagle. In other words, I went to quality. I went to beta instead of alpha, which I considered overpriced. I put the other half in the oil and gas business, which I continue to consider to be very, very cheap. I will not be increasing my position in juniors to the extent that I won't be adding new capital to it, but I will harvest gains as they occur and recycle that money into positions that I think are relatively more attractive. I will also participate, as I'm able, in private placements, with the note that over the last year, the fondness of the public and institutional investor for private placements means that the pricing that the industry has offered up has been appalling. Management teams don't seem to be able to spell warrant, claiming that they're dilution. Somehow they're able to spell options. I guess the dilutive difference between a warrant and an option is mostly who gets it. But until that is addressed, I'll likely be buying securities on market as opposed through private placement.
You already know why people hold gold. It's because it's real money. But what if you're now, I'm going to pull up a chart, Rick. So this is the silver price. And I think the same kind of argument can be made for gold as well. The silver price has gone up to $60. We can talk about that. People were people were celebrating at 40. And then it was euphoria at 50 because that was basically sustaining 50 was unprecedented. And now, look, there's very little reaction around 60. I guess people are used to this. First question, Rick, given how well metals have performed, is there still an investment case for resource stocks, juniors, mid-tiers, and or seniors? Why take the additional risk when the underlying could do so well?
The answer to that question is yes, yes, and yes. I believe, for reasons that you and I have discussed ad infinitum, perhaps even ad nauseum, that the purchasing power of the US dollar declines for 10 years, which means that the nominal price of gold increases for 10 years. I have also made the observation in interviews with you that when the momentum in gold attracts generalist investors into the precious metal space, when the momentum validates the narrative, silver begins to move faster than gold. It would appear in the last 5 or 6 weeks that that's happened. In fact, in the course of this year, silver has escalated roughly twice as fast as gold. This is concurrent with my experience in prior bull markets. It would seem now in this market, and we've seen this in terms of retail inflows to bullion-oriented ETFs, the generalist money is coming into the space. And when the momentum is established by both metals, gold and silver, what you see is that both the perception of the industry changes for the better, but the free cash flow of the producers also increases and the valuations increase. One thing that I would like to note, David, for your audience is we are due for continued earnings surprises. I've looked at the Bay Street consensus earnings, and they're using somewhere between 3,000 and 3,200 on the gold price to calculate their earnings. It would be difficult for an industry that sells gold for 4,200 not to beat consensus earnings estimates with a $3,200 base. So I think some present surprises are coming up. Remember too, David, that when we do it correctly, value these companies on a PNAV basis or an adjusted PNAV basis. I made the case with you earlier in an earlier interview that Agnico Eagle, as an example, despite doubling in share price, is cheaper on an enterprise value to PNAV basis than it was before the share price doubled, which is to say the net present value of current cash flows from their proved developed producing reserves at $4,200 is much more than twice as high as the net present value of those future cash flows was at $2,500. And you're seeing that reflected in the share price.
The fact that banks are using $3,200 gold in their net asset value, that signals low confidence that it'll stay around 4,000, or perhaps just part of their modeling process. They're taking the average of 2,000, which is before the big rally, and 4,000, which is the current price. So I'm not really sure how their assumptions are formed, but I have seen what you're talking about exactly, Rick. But how confident are you that $4,000 is not going to turn to $3,200 by next year, which is exactly what happened, by the way, in 2012?
I will guarantee you, David, and I don't guarantee much, that the gold market in the next 10 years will fall by 30% or more at least twice. It may fall by 50%. I'm not saying it will, and I'm not saying when it will. I will tell you this. I came of age in the gold bull market 1970 to 1980.
Yes.
The gold price increased 28-fold. In the middle of that bull market, in 1975, when the U.S. political class decided to raise interest rates, the gold price fell by half.
Yes, that's right.
It was an interesting memory for me. In the period 1970 1975, the gold price had gone from 35 bucks an ounce to 200 bucks an ounce, and it attracted a lot of adherents, people who had a religious interest in gold. When the gold price fell from $200 to $100, many of those people of faith deserted their religion. And in doing so, they missed a rebound in the gold price from $100 an ounce to $850 an ounce, an 8-fold increase that occurred over 5.5 short years. I guarantee you that the gold price at some point in time in the next decade, probably more than once, will fall 30 or 35%. I wouldn't be surprised at all to see it fall by 50%. If you are not prepared to be a rodeo rider, beware of the tertiary gold stocks. Own gold for insurance. In fact, own gold hoping it goes down in price, because the thing that makes it go up in price destroys most of the rest of your portfolio.
Give us one or two of these things that make it go to $5,000, $10,000. What happens to the rest of the world?
It depends on the response of policymakers. If, as the United States finally decided to do, in the form of Ronald Reagan and Paul Volcker, they raised the interest rate to accommodate for the deterioration in purchasing power of the US dollar, people spend less, save more, and the integrity of the dollar is restored. If they don't, there's going to be a real reckoning. We have discussed before, David, on your show, the dilemma that faces U.S. society with regards to private savings versus spending, in particular government spending. $38 trillion in on-balance sheet liabilities, $120 trillion in the net present value of entitlements. That number, the combined number, which exceeds $150 trillion, is offset in a very bleak way by two numbers. One, the private net worth of all American citizens, estimated by the IRS to be $161 trillion, which is to say there's $11 trillion in margin, and $5 trillion, which is the gross income of the federal government before any bombs are bought, before a ballroom is built at the White House, before any money gets spent. Think about trying to service $150 trillion in debt with $5 trillion in income. And then think about a creditor that's trying to service $150 trillion in debt with $5 trillion in income that is proposing to pay you an interest rate that is lower than the rate of deterioration of the dollar. This could work for a while. Society operates on trust. And trust was built up in the period 1982 to 2022. People have confidence in the dollar based on history, but not based on arithmetic. If that trust runs out, a couple things can happen. They can give a treasury auction that nobody comes to. That will shake confidence. We could have a liquidity squeeze. I'm not saying we will, but we could have a liquidity squeeze on the order of magnitude of 2008 or greater. Liquidity squeezes are all about a lack of confidence. I'm not saying any of these things has to happen, but I am saying that your listeners need to be psychologically prepared for them to happen and construct their portfolio in a way that accommodates the risk that's in front of them over the next 10 years. And a cornerstone of that, I would suggest, is precious metals.
Precious metals, but what about just other fiat currencies around the world? We don't have to specifically look at the dollar as the only safe haven. I mean, there's a Swiss franc, there's the Bank of Japan raising rates, like I mentioned. Yeah, go ahead.
That's a wonderful question. Despite the fact that your portfolio is penalized in terms of purchasing power by holding fiat currency denominated instruments, you have to maintain liquidity. The negative interest rate that you suffer, whether you own a Canadian dollar, a US dollar, an Australian dollar, a euro, really is an option premium so that you have liquidity if a liquidity squeeze comes. Despite the fact that you lose money holding cash, you have to own cash. I think that the next 10 years will resemble in many ways the decade of the 1970s, which is a decade where currencies relative to each other were volatile. And I think that savers will need to begin to be flexible around the currencies. I am one who believes that although the absolute strength of the US dollar will be poor, the relative strength of the US dollar relative to some other currencies, most other currencies, in fact, will do quite well. But I think that people will have to be nimble. I think, too, a lot of it depends on your circumstance. David, if you do business in the United States and do business in Canada, you probably will need to maintain liquidity in both currencies. You will probably need to maintain US dollar liquidity and Canadian dollar liquidity. You also will need to,
this guy says that word,
defend yourself from your government.
Liquidity.
I am maintaining savings in several currencies because I invest in several countries, but also, to the extent I can, I want to defend my liquidity from the idiocy of my administration, something that people around the world, I think, need to do. The most dangerous government, remember, is the one closest to you.
Well, okay. Let's write that down. Let's just end it here. No, I'm kidding. Quote of the day, Rick. We have a few minutes left. I want to ask you about the future of energy, and then we'll finish off on ranking mining stocks. The fact that you said there could be a reckoning in the U.S. monetary system, could there be a reckoning in the energy market? Which is to say,
I think a reckoning is coming in the energy market.
Yeah.
I think a reckoning is coming in the industrial materials market. I think it's fair to say that society has underinvested in the material stuff of humankind for 30 years. Particularly with regards to energy, it is estimated that sustaining capital investments by oil companies, including parastatal oil companies, the deferral in sustaining capital investments or the underinvestment in sustaining capital varies between $1 billion and $2 billion per day. It is estimated by the big thinkers, including your prime minister and our former president, that peak oil demand occurs in 2030. I would suggest to you, David, that peak oil demand doesn't occur in my lifetime and probably not in yours. Which means that oil and gas companies are substantially underpriced, and that unless new project investment and sustaining capital investment in oil and gas increases, that we will see higher and perhaps sharply higher energy prices in the 2 to 2.5 year time frame. Some of your listeners will say yes, but, which means they kind of agree with me, but it's inconvenient for their psyche. And they will say, well, what about alternative energies? What about non-carbon generating energies? To which I say that official estimates suggests that between $6 and $11 trillion have been invested in alternative energies in the last 45 years. And that, let's be conservative and call it $6 trillion investment, has reduced the market share of fossil fuels from a high of 83% 40 years ago, to a low of 81% today. A $6 trillion investment has reduced the market share of fossil fuels by 2%.
Interesting data point that is.
Investors who ignore, in particular, oil and gas, are doing their personal balance sheets a disservice.
Here's my yes, but notwithstanding what you said, the long-term outlook for energy demand and the transition to electrification rests on the assumption that global population growth will be sustainable, will still have the same kind of numbers as it did in decades prior. Here is the fertility rate currently. This is not a forecast. This is what it is now. And you can see that the largest 10 countries in the world, half of them have a fertility rate below 2. China is significantly now below 2, which is the replacement level. And so with the global population shrinking in the largest countries, and especially in developed countries, aren't we looking at the wrong place, Rick? Aren't we looking at growth where maybe there won't be as much growth? I'll let you answer that.
The challenge that you describe is real 10 years from now. Mm-hmm. It's offset by the fact that 1 billion people in the world have no access to primary electricity, and we're fixing that. It's offset by the fact that many of the countries that still are above replacement rates are very poor and becoming rapidly richer. When poor people get more money, the purchases that add utility are material purchases, in particularly energy intensive. The fact that we are beginning to experience less than replacement rate tells me that some of the difficulty that we would face in the 2035 timeframe will be alleviated by less population growth in those parts of the world that traditionally have been able to afford natural resources. But I think for the next 10 years, and by the way, all the net present value and investment is in the next 10 years, the declining birth rates that you describe will be more than accommodated for in general economic growth, per capita, particularly in developed nations. I think we discussed before, even in China, which has done the best job in recorded history in lifting people out of poverty, the Chinese Communist Party believes that there are between 100 and 150 million Chinese still living in rural penury that need to be lifted into the 21st century in the next 10 years. China being one example. If you multiply that by Nigeria, by Malawi, by Brazil, you see that the demographics that you talk about begin to be a concern 10 or 15 years out. The concern that we have to concern ourselves with the next 10 years is 3 decades of underinvestment in resources relative to the demographic growth and the increasing wealth across all demographic classes.
That makes sense. So perhaps 20 years from now, the population will start to fall off. But until then, the current population in the developing world still needs to transition to actually using energy. That's a very good point, Rick. Finally, tell us about, before we head off, and we got a couple minutes left, where do we find your work? And tell us about the service that you're providing to us, which is to rank our stocks. The process, I don't know if all my viewers are familiar with this process, but it's a great service that you're providing to your community. What do you look for when you rank stocks? Go ahead.
I should start off by saying it's a free service. I'm not charging for this.
Yes.
If you go to my website, ruleinvestmentmedia.com, and list your natural resource stocks, I personally will rank them 1 to 10, 1 being best, 10 being worst. Be a little patient, by the way. I've been on the road for 5 weeks. So expect a return to be 7 to 10 days. But once again, go to ruleinvestmentmedia.com, list your natural resource stocks, and if I follow them, I will rank them 1 to 10, and I will comment on individual issues if I think my comments might have value. Please, please, please. No crypto.
Surely that's
no
automated.
Tech stocks. No pot stocks. Leave an old man to do what he does best.
Do you comment on the portfolio overall? Let's say we've got 5 stocks, and 4 of them are great, but one of them is really bad. And that's the biggest weighting. I know that my portfolio's not great.
I don't do that. I don't rank portfolios because I don't know enough about individual aspiration or risk tolerance.
I understand.
I just try to rank the companies because I don't know anything about the people asking me the questions.
Okay, fair enough. Thank you very much, Rick. And just give us a few links or places where we can find you. Otherwise,
2 best places are ruleinvestmentmedia.com. And the Rule Classroom, where we have almost 300 hours of instructional programming, by the way, for free. Very good price, money back guarantee, of course, for free.
You're still working for free in your well into your 70s. I mean, that's an inspiration to a lot. Most people would have retired. Not only are you not retired, you're working for free.
Well, David, I do fairly well. What I do is I sell investor education as an example through those channels. So think of it as a very efficient form of advertising for me. I should tell your listeners too, in the United States and Canada, 1 third place to stay in touch with me is if you're unhappy with your current bank, which I suspect means every listener that you have, you should check out battlebank.com. where, as an example, you can save in 20 currencies, not just Canadian dollars or US dollars, where you earn interest on your checking account. $3 trillion on deposits in North America don't receive interest, and where you can use gold or silver as collateral for a revolving credit facility. If your banks don't do these things, which I guarantee you they don't, if you're interested in interest, check out battlebank.com.
Okay, we'll put the links down below. Thank you very much, Rick. We'll see you again soon. Take care for now.
Thank you, David. I look forward to that.
Thank you. And
Enough of that. You got food. I'm hungry. God damn, I'm so hungry. It's my laundry's about to be done. We'll leave that like this for a bit. This thing about to roll over or what? Or what? Or what?
I was late, they got loud, I got paid. Imbalance shift, no one felt. They chase dreams, I let it build. Tape moved in, Delta dry. You play chase, I watched it die. Reclaim level, that's my cue. Pull back with, got slipped through. Ops got hit, I don't blink. Pay post cope, I don't think. No follow, no intent. Price set stall, I took rent. One look up, then we dropped. Auction failed, I caught top. It broke, but no one followed. It spiked, but no one swallowed. It looked strong, but it was hollow. So I faded it. Broke that high, I couldn't hold. Candle popped, then it froze. TPO got left exposed. Fade that fake, that's how it goes. Auction failed, no bid stay. Volume light, structure sway. Price reversed, I was late. They got loud, I got paid. Price slide. I didn't. Auction failed. I fell. The math is the math. Marcos.
Chart too clean, math too mean. I marked it hella sharp. Jaw was loud, I played it smart. They went hype, I went calm. Now I'm dancing on that feel like art. Fibonacci, kiss that line. Price came in right on time. You want pump, I want range. You chase green, I chase gains.
Feeling hella good, feeling hella right. TP hit the zone, now I'm dancing through the night. Feeling hella clean, feeling hella sharp. Mark that trade at 10, now I'm parked inside the chart.
She a runner, she a chart star. Price ran off, left my limit fall. I had the zone mark, I played it smart, but she took off fast, tore my plan apart. No feels, just chills, I watched it go. No wick, no tag, that candle stole. I was patient, disciplined to the bone, but that breakout left me here alone. Heartbreak on a 5-minute screen. Waited weeks for this move so clean. Fit was sitting at 0.5. Thought we danced, just her and I. Yellow line held, I set my bid. 1 tick shy, she did what she did. News hit loud, she broke out wild. I was calm, but missed by a mile. Now I'm scrolling, slow motion, replaying charts like old emotions. Hopium hits when I see that wig, but the map said no chase, so I ain't clear. She a runner, she a chart star. Price ran off, left my limit far. I had the zone mark, I played it smart, but she took off fast, tore my plan apart. No feels, just chills, I watched it go. No wick, no tag, that candle stole. I was patient, disciplined to the bone, but that breakout left me here alone. No revenge, no FOMO spin, just deep breaths in my discipline. Next setup, I'll be there still, even if this one missed the field.
You still guessing? I'm still charged. Still floating. Still right. Marcos. I've been living that math life. With kids on, I don't ask twice. Top floor truck, got a glass pipe. Cookies in the wood tray past night. TP hit, got the dashboard glow. Price hit fib like it's stuck on code. She asked why I'm calm, I just know. They trade loud, I trade low. Back this line and treat divine. I ain't even blink when it crossed my line. 0.5 bounce, I just recline. That Bugatti wheel got chart design. Paddock on tilt, but the time stay perfect. Math too clean, I don't need no verdict. They get squeezed, I sip on sherbet. She said you psychic, I said just certain. Night got dim, but my screen still glow. High as Mars, but the levels still show. She said how you hit that so cold. I said swan ain't that golden clear. That math like with kids on, I don't ask twice. Top floor chalk, got a glass pipe. Cookies in a wood tray past night. TP hit, got the dash.
Silver, god damn.
Like stuck on code. She asked why I'm calm, I just know. They trade loud, I trade low. Wrist got snow, but the feel still hit. Watch don't tick, it just exists. Trade so smooth, it don't resist. Zone got touched, now back I lift. No rush moves, I let them drown. Fill him up, I slow it down. You hype on green, I vibe with math. You chase the trend, I fade that path. I don't get loud, I just get rich. I don't need calls, I got that script. I don't need edge, I am that edge. Just say yes when the wick got clipped. 618.5 golden touch.
This fucking song. Shout out to the fucking math.
Been living that math life. Big hit zone, I don't ask twice. Top floor chalk, got a glass pipe. Cookies in the wood tray past night. TP hit, got the dashboard glow. Price hit fib like it's stuck on code. She asked why I'm calm, I just know. They trade loud, I trade low.
Should we give that Tanya girl a chance? I think it's the only video we haven't watched, right? I think that's the only one left. That and like one of the ICT ones. Actually, they're both ICT traders. Did we ever watch this? I might have fallen asleep watching this. I don't remember watching this one.
I can show you.
I don't think there's any notes for this either, right? I must have fallen asleep. What's this video called?
Taking profits off rips, they need full setups. I just need a glimpse, yeah. Big size, bang, red wig, bang, bang. Chart talk slick, I slang, your little bag got bang. Ain't stressing no screen, I smoke. Top shelf haze, pure dope. They chase highs, I just float. Math move mean they get ghosts. No cap, I tap in a TPO zone.
Oh no, we didn't actually. Oh, interesting. This is the options guy too. I made like 17 million on that Nvidia trade.
Short, I'm clean while they foam mo clutch. Then I hit beach seats, feet up plush. Big size, bang.
Okay, let's make a section for this guy.
Ain't stressing no screen, I smoke. Roll up, top shelf haze, pure dope. Cookies, they chase highs, I just float. Drifting, math move mean they get ghosts. Marcos, I ain't gotta force it. The chart gon' talk if you draw right. They want signals, I want silence. Dang.
Every support and resistance level. I can show you the exact strategy I'd use, but if your mind isn't in the right place, you can't succeed long term. A successful trader understands that not every day is a good day for trading. There may be certain levels that are more probable to go well beyond that level, and there's certain days where you're just going to get stuck in a range. So you need to start with these three before you start learning all the technicals and all the strategies, because you're going to give all the money back if these three aren't the first things that you actually work on.
We have a very, very special guest. We did a podcast episode not long ago and it did absolutely insane numbers. He is a verified 8-figure trader, a phenomenal trader in the options market. It is the one and only Brando, aka Elite Options Trader.
Most new traders, they're so focused on like, I want to make money today, I want to make money this week, and I want to make the same amount every week. The way that I did it, the way that I think everyone should do it if you're new, is you have to align the level, which is extremely important because you need to know where to enter. To get the full picture, you have to understand that news and data is what moves the market. Zooming out is how you get the most important levels. Like doing intraday levels, like on a 5-minute or 10-minute chart, it's good for that day, but you're not going to get the prime trade setups unless you... Most of your money is made on big moments. Yes, of course, like as you get better, you can make money like every week, but it's nothing compared to waiting for these big levels. For the most of the big traders I know, like most of their profit, it's from these moments where you get... Reacting is everything for day trading. You don't need to predict every move. You need to understand that when you're trading. Having a strong bias when day trading, it can blow up your account because you'll...
True.
Welcome everyone back to Chart Fanatics, the go-to channel for...
True, right? We don't predict, we react. Right? Right or not right? Do not predict, we react.
The very best trading strategies and concepts in the world with the very best traders in the world as well. Talking of which, today we have a very, very special guest. We did a podcast episode not long ago and it did absolutely insane numbers. He is a verified 8-figure trader, a phenomenal trader in the options market. It is the one and only Brando, aka Elite Options Trader.
Thanks for having me.
My absolute pleasure, man. Thank you for making the trip out here to sunny Miami. And
what a name to brand himself with. Elite Options Trader. That's funny.
I've always been doing like Elite Options Trader, aka Brando, and I did an episode the other day, and someone was like, "Well, my actual name is." So it's that makes sense. It should be your real name and then our online name.
Sure.
Absolute pleasure to have you with us. I'm very excited to get into this. And what concept are we going to be getting into today?
So the main concept is very simple: support and resistance levels. I'm also going to touch up a little bit on the mindset of a successful trader and sizing for zero. I want to add a little bit more on that and why it's so important with options trading.
Love that. So where should we begin?
Okay, so the first thing I want to talk about is the mindset, because I can show you every support and resistance level. I can show you the exact strategy I'd use, but if your mind isn't in the right place, you can't succeed long term. So I'm just going to draw two people really quickly here. All right. So this is the successful trader and this is the unsuccessful trader. So there's 3 key traits of a successful trader that I think everyone needs to embody and to think about when you are pursuing this path. So the number 1 thing is the emotions, right? A successful trader, whether they're in a winning trade or a losing trade, they are always grounded, right? There's never a feeling of euphoria, and there's never a feeling of frustration and sadness for more than maybe a few minutes, right? They come back to neutral, and then they assess and they make the next best trade.
True. Fuck with that.
The number 2 thing is ability to see risk versus reward, right? So most traders, when they start trading, they think that every day is the same, right? You show up, you look at a chart, and you can make the same amount every day.
Yeah.
A successful trader understands
True.
that not every day is a good day for trading.
True.
And there may be certain levels that
fuck with this guy.
are probable to go well beyond that level, and there's certain days where you're just going to get stuck in a range.
Yeah.
So you need to be able to see this, right? Otherwise, you're going to go 2 steps forward, 1 step back every week, right? And then the third thing is the focus on learning, right? So learning is everything. In the beginning, most traders are just focused on making money, right? But successful traders, they understand that building the right fundamentals is the absolute key to long-term success. So that, to me, like, you need to start with these 3 before you start learning all the technicals and all the strategies, because you're going to give all the money back if these 3 aren't the first things that you actually work on. And then, for unsuccessful, right, it's the absolute opposite. The same thing with emotions, right? You have, you feel frustrated, you especially this, you feel a lot of anxiety, right? When you lose a trade, you want to make it back as quickly as you can. So, like, the second thing is just FOMO, right? That's probably the single biggest account killer.
Yes.
You know what I'm saying? So that, this alone, like, as a new trader, you're going to end up chasing trades you shouldn't be in, right? You see one guy making money, you enter the trade, you don't even know why you're in the trade, right? You don't know what the stock even is. And that's a big problem with new traders, is they just blindly buy. And then the third big thing is money, right? The new trader is so fixated on the end goal that they don't realize that if you build a bad foundation, it's going to crumble within a month, 2 months, 3 months at the absolute max. So for anyone that's watching this, like, you need to work on this at the absolute beginning.
Hey guys, just a very, very quick one. If you're enjoying this playbook and you want to get it sent directly to you, make sure to go on chartfanatics.com, play on as well.
Focusing on this, and I understand why. Like, why do most people become traders? They want to make money, of course, and they want that freedom, etc. But by focusing on it, that is what ends up making them in this bracket.
Yeah.
While the focus on process and learning puts them into that bracket, and as a byproduct, leads to the money. So the money really comes from doing these things. But unfortunately, for whatever reason, a lot of it comes down to, as you say, these 2 things. The FOMO usually leads to the focus on money. The desperate situation they might be in, and the lack of focus on, okay, let me build my savings, or let me work on my learning and my systems, all my emotions, and focusing on the right things will allow them to get the results.
Just focus on doing the right thing, right? If you do the right thing, the money will come. But if you're just focusing on the money and you're not doing the right thing, you are fucking cooked. You're gonna get your ass whooped out in these streets.
They want, and I guess the time horizon as well, right?
I gotta brush my teeth. But this thing about to start breaking down, or what? What? Or what?
Don't believe anytime. Anytimes. Marcos
said it's fake till price came kissing that dash. Pixel hit, no wig, just flash. Didn't react, just let it pass. Imaginary lines, but they always bounce like mad. Call it voodoo, now they gas. I say silence, still outclassed. Jar was dark, line still glowed. Dashing yellow script I wrote. Didn't draw that for the show. Prices came and hit it cold. I don't flinch, I don't speak. What came back, tapped it weak. Feel so clean, they call it cheat. Truth too sharp, they missed the peak. Overnight hit while I slept. Alarm said feel no second guess. They call dream, I call map. I place edge, they play stress. Till price came kissing that dash. Pixel hit, no wig, just flash. Didn't react, just let it pass. Imaginary lines, but they always bounce like mad. Called it voodoo, now they gas.
reminisce unless we close. Still untouched like frozen pros. They say random, I said coded. Now it taps, stop exploded. No motion, just routine. I sip slow, charts stay clean. They want chaos, I want flame. They want green, I want game. Visual sharp, that yo scar. Play so far, yeah, not bizarre. Seen too much to doubt that sign. They get wrecked, I realize. Lines for likes. I draw them to win. You pay price, obeys you. I know where it's been. Marcos. Said it's fake till price came kissing that dash. Pixel hit, no wig, just flash. React, just let it pass. Imaginary lines, but they always bounce like mad. Called it voodoo, now they gas. I stay silent, still outclass. Imaginary to them, precise to me. Math is the map. Marcos. Still blaze, still blaze, still blaze, still win, still calm, Marcos. Still blazing, yet loud on fire. But my levels hold clean, no liar. I don't stress, I just chart with ease. Math got me floating, profits breathe. Still faded, still hit that zone. Ops press buttons, I press the stone. They work hard, I let it align. He chase charts, I follow the sign. Top shelf flame, same pack as last. Chart move slow, I'll move past. No overthink, just let it top. Line too clean, they fall in trap. She said, you even focus now? I said, watch this wick come down. And it did like it always do. Draw that mark, let the trade come through. No bots, no stress, no noise. Just smooth entries, grown man poised. They draw clouds, I draw precision. Highs the sky, still making decisions. Still blazing, yeah, the loud on fire. But my levels hold clean, no liar. I don't stress, I just chart with ease. Math got me floating, profits breeze. Still faded, still hit that zone. Ops press buttons, I press just tone. They work hard, I let it align. He chase charts, I follow the sun. Chart so light, I barely touch. He overtrades, I don't rush. She roll one, I just lean back. TP hit while I count that stack. Stop loss hit, that wasn't mine. I don't guess, I trace design. Still too high, still too sharp. Still don't miss when I press that mark. You see stress, I see rhythm. You play odds, I play system. You chase gold, I'm in digits. All while vibing through these sessions. I'm smoked in, they press hard. I breathe in. Still blazing, yeah, the loud on fire. My levels hold clean, no liar. I don't stress, I just chart with ease. Math got me floating, profits breeze. Still faded, still hit that zone. Ops press buttons, I press the stone. They work hard, I let it align. He chase charts, I follow the sign. Still Still Marcos.
Still blazing. Okay.
Understanding that giving yourself enough time to get the reps in and to get consistent or show consistency. Because I think that comes down to it as well, where a trader doesn't have that consistency. They don't more than likely know a trader personally. They might know people online, but personally to really have that case study, that proof of concept.
Exactly.
So if they never give themselves an opportunity to actually build that, using these principles, as you mentioned, like actually focusing on the learning, the risk reward side, balancing their emotions, having the right processes, instead of focusing on this side, where they focus on the money kind of leads to FOMO, right? And then obviously that FOMO creates that anxiety. So the kind of knock-on effect, right?
Exactly. Yeah. So
where should we go from here?
Yeah. So now I'm going to show you guys why support and resistance levels are so important and why trading and looking at levels on a daily and weekly time frame are key.
Yeah.
So
Support resistance, right?
yep. All right, so I'm gonna show you guys the past 4 big sell-offs in the market. I'm just gonna first like just write which years they happened, right? So 2018, 2020, 2022, and most recently 2025.
Yes.
All right. So these are rough.
When is this from?
Estimated numbers. Some are exact, but I'm just gonna write them out.
Yeah, of course.
So 2018
Post
the top
tariff
was
dump?
around, let's say 29.40, right? And the bottom, so the top, we'll just put T, and then the bottom was around 23.46,
Mhm.
right? And this sell-off was due to the tariffs in 2018 with Trump, right? 2020, the top.
Is this S&P?
This is S&P 500.
Gotcha.
We'll do SPX. So in 2020, right, we had the top I think around 33.93, and it dipped to 21.91, right?
This guy's down to the
And
digit.
then 2022 top, right, when this was at 48.18 at the top.
Motherfucker's a nerd.
91, right? And this is when QE stopped, right? The Fed said we're done, right? So they start QT, right? And then 2025 was tariffs again, right? So we got top of 61.47, and at the lows we went to 48.35.
Let's just hope that we don't get a
This guy, is this right? 6147? This guy's a fucking quote side. Down there. God damn. God damn.
Yeah, exactly, right?
But just to confirm,
That's a bigger nerd than
QE is
me.
quantitative easing, QT quantitative tightening.
Yep. So basically, the Fed was saying they're going to shrink the balance sheet, and rates were going to start going back up, interest rates. So if you look at these numbers, right, and you look at these major sell-offs, each time they provided a huge opportunity to buy the dip, right? And did you need to buy the dip here at 23.46 to make money? You didn't, right? Over time, eventually we got back above this 2900 level, right? And if you bought here at this 29.40, you can ride this level all the way up to the new high in 2020, 33.93, right? And then when COVID happened, right, it was pretty much a black swan event where the market had a huge sell-off within a couple weeks, right? So the first time it dipped, we got, I think, 27% sell-off, and then we had 35% here. And then I think this one was 21%. And this is around, I think this one might have been 21 and this is 27. Math might be off, but just they're all
Close enough, yeah.
they're all above 20, right?
Yeah.
So so going back to COVID, right? We had that black swan event, and I mean we had a 35% sell off. Did you need to buy here? No. But if you waited for the reclamation of this level, the low from 2018, that was your buy point, right? So buying there, like trading options, like you could make 1,000% on an option like 3 months out, 6 months out. Like you don't need to trade weekly options like I do to make money on these type of trades. But waiting for these major levels this is how you want to start trading. Meaning like most new traders, they're so focused on like, I want to make money today, I want to make money this week, and I want to make the same amount every week. But the way that I did it, the way that I think everyone should do it if you're new, is you want to start off on the right foot, right? These trades, it may take 3 months, 6 months, a year for it to actually come. But if you can 10x your account on the first really good setup, then you'll have much more capital to play around with, right? And you'll build the confidence to actually trade the right way. Because with trading, especially options, if you don't see success within the first 3 months, about 50% of traders will quit.
Yeah.
And then within 6 months, if they don't see any success, you're about at like 80% will stop. And by the year mark, if they don't see anything, 90% are done.
Yep.
So
Is that the actual math? The typical saying is 90, 90, 90, right? 90% of traders will lose 90% of their money in 90 days. I mean, this guy, I mean, we watched an interview with him before, so we know he trades more actively than this. Like, this is what we were talking about like an hour ago at the start of the stream, right? You are praying for fucking times like this to get into a bear market. Literally on your fucking hands and knees praying to God. Please dip the market like that. God damn.
Time frames, these daily and weekly type of levels, these are the ones where you make the most money, right? So like you see here, like even here, right, in 2022, we bottomed at 34.91. We got within 100 points of that 2020 high. And if you bought near that level, right, it's not perfect, it's not exact, but it's a relative range. You could have made huge money. I mean, you went from 34.91 to 61.47 recently, right? And even if you buy options 6 months out, I mean, you can 10x, 15x your position, right? And so this is kind of just like a start to what I want to focus on is like showing you guys why trading the biggest levels is how you make money. So
Let's take a break for a minute there, guys, because I want to tell you about our preferred prop firm, Apex Trader Funding. Trader today. Now let's get back to the episode.
It's really actually great because you can visually see even just within 7 years.
Yeah.
Right. Just at the low, like the comparable between a bottom 7 years ago and then the top we've seen so far, and where are we going to go next?
Yeah.
It's incredible. Yeah.
So the next, like the way that I kind of set up my my trades and the way I view the market is the market, it moves on news, right? Of course, like technicals are very important, but the way that I set up each week is like, okay, what news or data is coming out this week, right?
Yeah.
So I'll do Monday, Tuesday, Wednesday, Thursday, and Friday. And let's just say this week is a Fed meeting.
Yeah.
Right. So I'll put, okay, FOMC's this day, and I'll trade around that. Meaning before FOMC, like if there are any opportunities, I'll treat it as a quicker trade. But I know the big move will happen after. So typically after FOMC, you'll see about a 1.7% move in the S&P, right? And volatility is typically like 25% higher vol, right? So if you know that, then when you're day trading, you need to be patient and you need to wait until Powell's done talking and then trade. Right.
Yeah.
Versus like most traders will treat every day the same. Okay, I'm gonna trade like this, and I have a bias here, and this and that. But you need to learn to just understand what data is coming, who's speaking, and then react to it. That's the way to do it.
So rather than just coming in and kind of get essentially caught off guard.
Yeah.
And you may have a plan for a particular move, but then not knowing. I think a lot of traders may know this. A lot of traders won't as well, but a lot of traders may know, okay, we have something today, but this is very important.
Yeah.
Right. Understanding, okay, average moves, understanding average volatility, especially in options.
Yep.
That is the difference between being more informed, understanding your actual plan for the day, and it's a very.
I go about it differently, but I'm not trading options into this stuff. And typically, as we head towards FOMC, usually I want to be in a long from lower and a short from higher of whatever the current price action is, like a week before. So that there's like wiggle room to not get whipsawed on the day of FOMC, and then whichever one ends up running runs. Doesn't always work out that way, but that's usually the kind of goal we try to set for ourselves.
It's very simple, right? It's very simple to sort of kind of understand this, but I think it's a very important highlighted feature that you just put there because, again, most traders would say, okay, what news do we have today? Oh, great, okay, 7 p.m. or EST time, maybe like afternoon time. Oh, great, we have Kapow speaking. Okay, I'll keep an eye on that.
Yep.
Versus understanding that, okay, this is a sort of average move we're looking at here, and the vol as well, and any other factors as well that might come into play. And I think that's where the difference, and it's a really good visual element of like the difference between the surface level, right, just looking at the surface versus the deeper understanding.
For sure, yeah.
Also, this thing about planning out the week, how he's talking about
surface level, right, just looking.
You can just use like AI for this nowadays, right? Just go onto your tool of choice and just get it to make a calendar for you. Just say today is Sunday, whatever. Give me the upcoming news and notable events for the market this week and all potential big data that's coming out and expectations. And you can also even ask it to give you like potential implications of these data, right? What is expected if this data comes better than expected? What happens if it comes as expected? What happens if it comes worse than expected? It'll give you like a nice, you can put into a PDF and you're kind of good to go for the week, right? Because there are times when I do that and there's things I miss that the AI like catches for me and I'm like, oh, sick, nice. Go to the AI.
Surface versus the deeper understanding.
For sure, yeah. So like once you have that set up of just a general structure of what's going on during the week, then next is when you look at the technical. So I'll just give you guys a quick example here. So this is from, I think, about July of last year to September 2024. Okay. And let me just draw a chart here. So, all right. So this right here will mark September 2024. So, and then this level, right? So this will be July. This will be August and September. So there was a Fed meeting here. Okay, so this is last year when the market kind of topped here in July, and then it dipped for about a month, came back here.
Yeah.
So most people will when they trade this, right? They'll say, okay, well, we topped on July 56.70, right? And then we got a retest here in August. So most traders will be like, okay, I'm gonna trade the breakout here, and this is probably gonna work because I love charts and I love to be very technical. But like I said, the market moves on news, and if you notice in August there was no Fed meeting, right? It doesn't happen every month. So it didn't have a catalyst to actually break out.
Also, like a low
on the
liquidity
July top.
season,
Right.
typically.
So most like new traders would be like, okay, well, I'm gonna go full size and I'm gonna trade this breakout level. But like a more well-rounded trader will be like, okay, well, what's the catalyst to actually get it through? And
More
in August, there was
sophisticated
none.
player.
And in terms of seasonality, August is not necessarily the best month for trading. So
I mean, this guy
Figures out.
fucking. Like, you see what I mean? Like, you guys see what I like? You can just tell when people know what they're talking about and are like higher ranked traders versus some of these other people who you just know, right? Like they're just kind of just sitting here, just kind of just going through the motions, repeating some pattern they learned from someone else. Then you get like once in a while you come across people that give things thought, right? They think about the game themselves, come up with their own ideas of how to interpret things. That's what you need to do, right? If you're not kind of like innovating in any regard, or you're just literally following the footsteps of other with no thought of your own, you will never climb the ranks to like the highest of ranks, right? But hold on, they'll be back in a second.
See him. But price keep touching. Dash that line. Then detonate. Marcos. Oh! What up? Dash line yellow, bounce too clean. Pixel tap twice, now they call it scheme. Said it ain't real, chart said please. Price don't lie, it hit my keys. Dash line ghost, still got weight. Chart come back like I set that fate. No fib, no tool, no glow, just space. But it hit 3 times like I own that place. Line too light, but the impact heavy. They draw clouds, I move steady. You wait for break, I mark the cause. Price hit me, then hit pause. You post zones, I post traps. You watch prints, I run maps. They call fake, I call flash. You chase highs, I draw dash. Main girl watching, said hi no. I said it's math, not ego. They think chaos, I see code. You call hope, I call.
Okay. Yeah, I think I like what this guy so far. He's like he's a numbers nerd, right? Clearly knows his numbers.
really caught the move was in September, right? We had the Fed meeting, right? The catalyst, another example there is you wait for the Fed meeting, and when they announced that rate cut, I mean, we got the move. I think it was like 1.8% and beyond, and SPX moved 200 points,
Wow.
right? Within I think like 2 weeks, which at the time it's huge.
Mhm.
Like in this current market, it doesn't seem like a lot, right? Because but I mean at that time you made a lot of money, and when it finally got through 56.70, right? Like I said, it got to like 58.70 within a couple of weeks, and then obviously we had more and more, and then eventually topped out 61.47. So you have to align the level, which is extremely important because you need to know where to enter. But to get the full picture, you have to understand that news and data is what moves the market.
Definitely. That's
Right.
where you're going to get your volume, and that's where you're going to get really your catalyst for the moves.
Yep.
So understanding and pairing where you're technically at, and understanding really good highlight in terms of, okay, we had a top, and you might be expecting a breakout level, but we don't have the catalyst. So if the trader's sizing up and preparing for potentially this move, again, it's that context is missing. And yes, the market could do something, but what is the probability of it happening if we have no catalyst and no volatility to really give it its drive versus, if anything, builds more liquidity, builds more of an area and a chance of it taking place, and actually builds the probability by leaving it to then when we have the catalyst in place and then the right timing, essentially, to then be able to take advantage of this move.
Yep. And then so for options trading, right? You need to look at the news and data, understand the levels, and then like we talked about on the last podcast is like size for zero.
Yes.
This is for options trading, right? This is not for trading shares. But
size for zero, for sure.
So the point of doing this size for zero is you're looking at your max risk first. So when you enter, you're never caught off guard by a red P&L.
Yeah.
And for me, I trade weekly options, so they have the highest volatility, and sometimes it's zero DTE. So sizing for zero, it's going to put you in a position where you're ready for max gain and max loss. And when you have that mindset with trading, it's going to put you in a position where you're always going to be in control.
Yeah.
So yeah, everyone, I think that's watching, think about this. You don't have to do it, but you need to consider.
As an example,
To always be prepared for a worst case scenario, right? Essentially, it doesn't matter what kind of instrument you're using to trade or product.
Visualize what that looks like on the chart. So for example, if an entry took place at this level, I don't know, here, for example, and you're sizing for zero. If you were to place a stop, you might put it, let's say, I don't know, here. But if you're sizing for zero, what would that look like in terms of area?
Okay.
How does that look in terms of on the charts if you were to actually hit zero?
Oh, okay.
How does that look?
I mean, it depends on the strike, but like I'll give you an example of like what it looks like for the actual so like say it's a $5,000 position, right?
Right.
So most traders will be like, okay, I'm gonna do a 20% stop loss. So when it gets down to $4,000, they'll be like, okay, stop loss.
Okay.
But for me, I'll just buy $1,000 worth. This will be my position. And
Yeah.
so instead of like having such a 20% stop, right?
You set your position as that same amount.
Yeah. So like, because 20% is also very tight for options. Doing it this way, 1,000 as your max risk, you can hold those for like 5x to 10x, and like it won't bother you. Like meaning like you won't get anxious or like.
Yeah. So essentially, you're risking the same.
Yeah.
But you're just allowing it rather than choking it.
Yeah.
You're giving it the room to breathe.
Exactly. Yeah. And it's really important for options because you can see an option go down like 60% one day, and the next day comes back and it runs like 300-400%.
Yeah.
Right. So and there's nothing more frustrating than seeing that.
I can imagine.
Yeah. Yeah. So.
Well, it's so interesting though, because even though we're referring to options here, but it's the same principle within, say, like futures and forex, where you're just choking the trade with trying to almost not give it enough room and trying to almost have this picture perfect trade. A lot of traders try and capture the wick, right? Get the sniper entry, as they say. Well, a lot of the time though, even though they're trying to do that and they might get one good screenshot out of it, in reality, over a basket of trades, they're losing out big time. And
You're not even know what you're doing, boy.
To review and reflect on that, if you'd given it the necessary room.
We're top ticking, bottom ticking shit every fucking day.
But a lot of the time, one, traders aren't reviewing. Two, they're just too focused on that being the perfect trader or looking like a perfect trader versus actually being a profitable trader, which is always an interesting mindset. But yeah, no, I love that because again, as you said, on the last pod, that was an interesting topic, which I think majority of those just didn't understand the differences between options and other styles of trading.
Yeah.
But this makes complete sense, and yeah, I'm glad we were able to make that visual as well.
Cool. All right, so I'm gonna do another like setup here. So news and data, right? And then we'll do the Monday, Tuesday, Wednesday, Thursday, Friday, and then we'll do the chart again. All right, so let me do this. So this is the top from, was it February? Yeah. Right, this is 6,000 level. We'll say this is around 6,100. Right, so what caused the sell-off here, right? It was the tariffs. So, right, so in February, Trump tariffs with Canada, Mexico, and China. Right.
Right.
So early February, he started, talking about it and then started implementing it, and the market was still holding up. But the straw that broke the camel's back was in late February. We had consumer sentiment data. I don't remember what day it was. I think it might have been on a Friday, right? And early February, we started to see signs of like, okay, the market could start to pull back because Trump is starting to really focus on these tariffs.
Yeah.
And for SPX. But it wasn't until we saw this data right here that caused the complete sell-off of the market. So this came out, I think, on a Friday. I think it was February 21st, right? And SPX dropped from 6147 to almost 6,000, right? It dropped like 140 points in the same day,
wow.
Right? So the question is like, people will say, well, how do you catch a move like that so fast? And you don't need to catch it the same day to make money, right? And with trading support and resistance levels, round numbers are big, right? People love to trade upside and downside on these levels. And looking at the news and the data.
Also very common for algorithms.
Right. People don't like tariffs. In 2018, we saw that. The market had over a 20% sell-off before it bottomed. And then that was the news, right? But then we had the data behind it coupled with this to trigger the eventually the big sell-off all the way down to 4,800, right? So did you have to trade that 140 point move that day to make money? No, you didn't. You could have taken the 6,000 break, which is a level that is such a round number. It's like 100, 500, 1,000, 2,000 and beyond. So I took puts on the 6,000 break when this happened, and eventually, within 5 days, right, SPX dropped 200 points, right, and then within 2 weeks, right, SPX down 500 points,
wow.
Right, and then within 5 weeks, I think about 5 to 7 weeks, we'll say 6 to 6 weeks, SPX dropped down there. Right.
Yeah.
So I mean, you had a 1,300 point drop from the top. Did you need to catch it there? No, you could do it there. You still get almost 1,200 points. So, looking at the news, you have to interpret it properly, understanding that okay, well, history's repeating itself in 2018, and we could see another 20% sell off, which we did, right? I mean, at the bottom we're 20%, 21%, right? And then you look at the data coming out. Well, consumers seem to be scared of what's happening, and you couple those two things, those two big pieces of information with the level, and that's how you make money.
How do you identify your levels? Obviously, as you mentioned already, round numbers are powerful. But is there anything else in terms of prices interaction at certain levels or certain areas? Like, how are you identifying these levels?
So looking at like daily and weekly charts, when you zoom out, you'll be able to see where a level has resisted, and how much it's sold off.
Yeah.
Right. Like for example, like on the previous one, like we had like COVID, right?
Mhm.
It dropped from where did it drop from 33.93 down to 21.91.
Yeah.
Right. So like we know this is like a major top, right? So this is, I'm just like COVID. So this is a major top, right? And then seeing a 35% sell off. There's also, I mean, that's unheard of. Like we haven't seen that in probably 25 years or beyond, seeing a 35% sell off. So understanding on the weekly time frame, like major tops, right? And then if you zoom back like 21.91, on a weekly chart as well, it was a major support for a long time. So zooming out is how you get the most important levels. Like doing intraday levels, like on a 5-minute or 10-minute chart, it's good for that day, but you're not going to get the prime trade setups unless you zoom out to daily, weekly, and even monthly, if you need to.
Yeah.
But the bread and butter is
Yeah, that's why we mark them out, right? We got the monthly and the quarterly levels on this bitch. Ain't no fucking joke. No joke.
Let's take a break for a minute there, guys, because I want to tell you about our incredible sponsor, TradeZeller. TradeZeller is the #1 trading tool
Where's
in
the
the
button?
entire trading industry. TradeZeller today. Now let's get back to the
You heard me.
Daily and weekly time frames. Then, as you mentioned, so for example, if we say this is our top, for example, is it the interaction there as well? So, say for example, on a weekly, we're seeing like some large sort of wicks and sort of tops failing to break this high. We then come back down, and then let's say down here is our low, and you see actually something like this was down here. So when price is coming back down, and again we struggle at this level, is this what we're identifying in terms of the interaction?
Exactly. Yeah.
Yeah.
So you want to see it pretty much defend it. It doesn't need to be that long either.
Yeah.
Like if it hits a major level, it should bounce fairly quickly. So
And that's ideally what you want as well in terms of like being able to identify a good probable trade is that strong reaction. And as you say, really focusing on those higher time frames provides more weight versus on your much lower time frames, your more intraday.
yeah. And I'll just show you something. I'm going to keep like most of this chart. I just want to show you something really quickly here. Okay. So, we recently bottomed, right? Around April 9th. April 7th was this low, right? And then on the 9th, we had that big bounce. So like this 48.35 level, if you go back to like 2022, right? The high was 48.18, right? So 3 years later, I mean, it pretty much back tested a major top. And that was, we took calls that day and the next day. And then April 9th, right? Can't spell. April 9th, we had a 90-day delay in tariffs. Right, and SPX bounced 600 points within 2 days. So like even if like you don't understand this sometimes, and you don't, it's a little too complicated in the beginning. Like if you understand the major levels and where to trade off, you have to take the shot. And I mean, 600 points in 2 days. I mean, if you're trading SPX, premiums were inflated, but I mean, you can make 500,000% like within a couple of days trading these levels. But my risk appetite's higher. I'll do it, but you can go 3 months out, 6 months out, and still make good money. But it's a good example of like, okay, if you know the level and you study them, like you have to take that trade.
Definitely. And that's a big part of it is that studying. And that's why I love like where you started in terms of the mindset and the characteristics and processes of the profitable versus unprofitable, because at the end of the day, to be able to execute on this, and I wouldn't even say this is necessarily complicated in terms of a system. I think it's very understandable, simple, and especially I love the focus on where is that volatility and that catalyst going to come from, understanding your levels. Focusing obviously on the higher probable levels with the
Curious
higher
what his
time.
trading
And
frequency
then,
is,
basically
because this is
what-
like
I think what
quite
you just mentioned there in terms of risk appetite is very important, because from risk appetite to also experience level, you
zoomed
want to
out,
match those
right?
up, because I can imagine a lot of traders who are quite new, still probably finding their feet, jump into trying to take that higher risk appetite simply to make the higher reward. When in reality, that's probably burning them because they're not ready for that risk appetite. They're not ready to handle that volatility or the speed or the be able to make the necessary decisions, especially when it comes to the trade management side, and therefore hurting themselves and almost making themselves question what they're doing versus if they just were able to match, the system are finding their feet to the correct risk appetite, they'd probably actually have better results, which would build their confidence, which would actually speed up, I do that in quotations just to say we're not trying to say this is a fast route, but it would speed up the actual process to getting to having a higher risk appetite versus what they're doing where they actually end up delaying it because they're causing harm to themselves and they're probably second guessing themselves and end up probably having breaks or boom and bust cycle. And again, going back to your original point, the FOMO and the anxiety that comes with that. Yeah, so I think this is an incredible system, nice and simple. And this is exactly what you're looking at within the markets.
Yeah, this is exactly how I trade. It's a lot of waiting. Like people think of day trading is like this like flashy, like you're making huge money every day, but you're just waiting a lot. Like most of your money is made on these big moments.
Yeah.
Right. Yes, of course. Like as you get better, you can make money like every week, but it's nothing compared to waiting for these big levels. This is for the most of the big traders I know. Like most of their profits, it's from these moments where you get huge tariff news and the market drops 20% in 2 months.
And how often would you say this is taking place? Like this sort of opportunity, is it very much a handful of times a year, more than likely?
For the one in 2025, I would say it happens every 3 to 4 years, right? But after you get good at waiting for these type of trades and you make money from these trades, you'll build the right foundation to the point where you've mastered the wide time frame, and now you have the right foundation, and you can start trading smaller time frames, meaning a resistance level that's been there for a month or 2 months, and you know how to do it because you did it the right way the first time, right?
Definitely. So like frequency here is obviously much higher, but as you build your confidence and bring it lower, what would you say that frequency looks like on sort of a month to month or week to week basis?
Yeah. So
is it dependent obviously as well of what you're looking at? So this is just SPX that we've been covering, but you could be looking at other instruments as well, which would increase the frequency based on the wider range that you're looking at.
Yeah. So basically, like these come every 3 to 4 years, right? And there's obviously many more support and resistance levels, and there's some that are important within a 6 month time frame, a 3 month time frame, a 1 month time frame, and even on a weekly time frame. And like I said, once you build the right foundation of mastering these, you use that data and you use that scale and you apply it to the smaller time frames. And that's like with me, like I trade much more frequently now, but it's only because I mastered this first.
I think that's a problem that a lot of traders do, is they rush too quickly to those lower time frames to increase the frequency, but then don't have the reps and the confidence necessary really to execute efficiently, and therefore again go into that boom and bust.
Exactly.
Is that what you the third point?
I'm not sure if I necessarily agree with that, right? Like, take a double-edged sword. If you're trading on the lower time frames, you're gonna get like a lot more reps in, but you also have to like realize that you're trading a lot more noise, and like levels are less likely to be respected, right? Like this line right here, like if this was a daily chart, like let's say this was like a monthly chart and price is like coming up into this zone right here, a lot more likely to see a reaction, right? Even if it's just like a short-term rejection and then into the pop. Whereas like if this is like a 1 minute chart, you can't have that kind of like, you have to have the weighting different in your head. But on the other side, like in terms of the frequency, it is better, and the concepts apply regardless, right? They're typically the same concepts regardless of the time frame.
Point being the learning. This is essentially that learning, being able to be patient enough to learn and develop your skill set and put your reps in, versus the opposite where you're focused on money. So what's the easiest and fastest way to make money? Oh, let's start trading lower time frames and get in there and get active, versus let's actually develop ourselves into an actual trader. Because the other method, like the anxiety, the FOMO, and the money side, that's really, if we label it, that's like gambling.
Exactly. Yeah.
Versus trading. And there's a clear difference, and there's a fine line. And that was the line in the divide, is like when we're focused on this side, that is where we're essentially gambling. But on this side, that is the trading element. And that focus on process and learning consistently as well, I think is so important. And you can tell the level of detail and learning that you've done yourself, because obviously you have, I don't know how you remembered half of these numbers, because I would definitely not been able to do that, which is incredible. And especially when it came to the breakdown of our highs and lows, that was really eye-opening in terms of like, even just from an investing standpoint, of understanding that within a 7-year period, we literally almost tripled, or if not, we did triple pretty much, a low in just 2018, 7 years ago.
Yeah,
which is incredible. Yeah, where do we go from here?
Okay, so we can do the pros and cons.
Yeah,
of it.
sure.
Yeah. So, all right. So the pros of support and resistance. All right, the strategy.
And just as always, cons wise, we don't mean it's bad. It's normally just things to be aware of, things that maybe a hurdle or something that you should know when looking to implement this.
Yep. So the biggest pro of doing this strategy, right, especially trading the levels I mentioned on these big sell-offs, is they're high probability.
Yeah.
Right. So
that too, right? That's the other thing about the different time frames, is like the probability gets much higher on these like overextended moves like this. It's the difference to see a 1 minute move like this, where you're seeing like this happening, along with like other like mean reversion type data. versus like a fucking weekly chart seeing that kind of shit. Also, like the notional value of the move itself is like very different. Like on this kind of chart, like this is like a what, a 5% move. Whereas if you're doing this on like a weekly chart, this kind of move, like suppose these are all weekly candles, this would be like a massive move most likely, right? Like double-digit percents. So if you're like leveraging up via whatever instrument you want, that's like pretty insane gains.
I would say
with high probability.
80%. Wow. Right. Plus. So you have to ask yourself the question, when you first start trading, do you want to just trade every day and for the sake of just trying to make money? Or do you actually want to wait for something that has the best chance of you winning?
Yeah.
And that alone should, open the eyes of anyone viewing this. Is like, you need to wait for these type of trades if you want to make money.
Yeah.
And the
True.
second part is, so yeah, high probability. The second part,
We'll add the caveats or like the asterisk on that statement that you can make money trading with lower time frames, obviously, but these kind of events that we're talking about, this is when you want to go in max fucking risk, right? Because like the risk reward on trades like this is so fucking skewed.
part is growing an account, right? So I'm not saying everyone can 5 or 10x their account, but if you wait for these big levels, that you have the highest probability of doing it with trading options.
Yeah.
So that's the beauty also behind trading options. You don't need a lot of capital to start with, but I mean, I've seen people turn 5 grand into 100 grand, 200 grand, like even recently, the past week.
Really? Wow.
Yeah, the market moved a lot last week. But yeah, that the second part is, obviously everyone wants to grow their account, but you need to wait for these in order to do that.
Of course.
Right. The third part is you're gonna learn the learning part, right?
Mhm.
You're gonna learn the fundamentals and the right foundation, right?
Just to go to this point here, growing an account, the patience, high probable trades, even if someone with lower capital, say they have 5K, example, as a starting capital, if they're 5 to 10xing their account, that's where they're getting that jump of like 25 to 50K.
Yeah.
In one jump without gambling, without taking unnecessary risks, with a good system. And that can literally be what jumpstarts their career as a trader, really.
Yeah.
And I think a lot of people don't understand the power of being able to do something like that.
True.
Versus trying to do it by taking 100 different trades within 50 days and that rushing almost, that lack of that time horizon versus this can be a singular, very minute opportunity, but if executed properly, can literally be the thing that really starts off your career, which allows you then to be able to increase the frequency and start to build, most of all, obviously.
It's how you can snowball, right? Like, just think about it. Like, just think about it. These trades might not come out that often. Let's just say they come out 3 to 4 times a year, right? And you take 4 of them and 3 of them work out through like 75% win rate. And each one that you win, you like grow your account and like let's just say double it, which is like a bit of a stretch, right? Because ideally you're not risking too much. I mean, you can if you have a low amount of capital, then yeah, you can be a bit more risky with it because like restarting is not that big of a deal. Well, let's just run with that example, right? Let's just actually run with that example. If you have a small account and then 2 or 3 of these 4 trades hit, and each one of them you're doubling your account, then your account just grew a shit ton, right? Like from 1 to 2, 2 to 4. And the third one, 4 to 8. You just grew your account 8x in 3 trades. I wouldn't recommend going about it this way if you have a lot of size. Because it's pretty risky, right? The one that doesn't hit, you just fucking nuke your account equity curve. But it depends on how you look at it. Because at the same time, like, sure, maybe that one nukes your account a bit. But then if you do the same thing again the next time and it ends up running, then you just got it all back and then some. So that's where we start to kind of get into the personal preference of trading. Not everybody's comfortable risking that much on one trade, even if there is like a much higher theoretical upside.
Think about it, like anyone watching this is like, it would be me saying to you, okay, Rez, you're a brand new trader. You start with 10 grand. I want you to come to this room every day, right? I'm going to give you a computer screen. You can have access to your cash. And if you just sit here every day, I'll give you 100 grand by the end of the year, right? But you got to sit, you can't take any trades, right? But the problem is most people can't do that, right? They can't wait that long to see that type of reward. They want to trade every single day. So being able to just sit there, right, for most days and just wait, it's the hardest part, but that's what's going to make you money.
I think it's the assumption that, hey, if I actually do trade more, I'll make more than 100 grand.
It's also like a fair point, right? Like how do we phrase this? If you don't have a cushion of money when you start trading, then like this kind of style, it probably seems like very off-putting to people, right? Because you could go like a month without making money, 2 months without making money, and you don't have like a cushion to sit back on to like pay your bills and whatnot. Then like this seems like, oh, fuck that. But like if you kind of ignore those stresses and kind of like take this approach, like this mindset of trading, it's the best way to do it, right? And there are a lot of funds that operate the same way. Like there's periods in the year where they have no trades on. And they're just sitting on their hands waiting. And a lot of traders do that too, not just like funds.
The idea, the fantasy.
Yep. So some people can't do it. Don't get me wrong, but most people that are new, you gotta
Exactly, the new element is very important. Like there are people who do it. A lot of the time they're not new. You know?
Yeah.
And again, I feel like the problem that happens is there are people who do it very early, but it's always like the minute number. Like it's not even 1 or 5%, for example. It's literally like a 0.01. And I get it in terms of everyone. It's a nice idea that everyone would think that they're that person. It's actually a good thing in terms of the self-belief element. Like you believe in yourself that much that you're that person. That is great. However, the reality, unfortunately, is if you're not really showing that quite quickly, you're not that person, which is not a problem because you will still, hopefully, by doing this, be a 1% trader overall, because the majority of people fail and the majority of people don't make it. So you'd still be in the top percentile of traders. And that's actually phenomenal. Because I found that where, a lot of traders have the goal of maybe being a 7-figure trader, 8-figure trader, even 9-figure trader. They say it, and it's great to have those goals, but they never really look into what it takes to be that level of trader. And the problem with that is that then they never actually, because they don't understand, they're not implementing the right processes. They're not really bringing the right mindset. They're not really doing the right practices because they don't understand what it's going to take. And therefore they have this, I wouldn't say unrealistic goal, but they have this goal, but it's only unrealistic because they're doing all the wrong things. That is not leading them that way. Versus this, as we say, is a strong foundation. And it's an interesting one. It would be we should try and contact Mr. Beast and say, look, a trader is offered $1 million if they don't take a trade for a whole year. See what happens.
Imagine.
Maybe that's an idea for me to start.
Yeah.
That's great.
Cool.
Any more pros? Or
you know what? These are the main 3, I would say.
Yeah.
Let's go over some of the cons.
Yeah,
and then, so there's not a lot of cons, but we'll just talk about a couple. So the number 1 is there's a lot of just waiting.
Yeah.
Right.
Patience,
like,
basically.
It's not glamorous, like trading the style, right? It's not flashy. You're not going to be making huge gains every single week. But if you do this part, then eventually it will be.
Yeah.
You'll get to a level where you are that 7-figure trader, maybe even 8-figure trader.
Yeah.
Right. But this is the biggest con, and most people don't have patience, right? Like even in your daily life, like how many people do you know that can actually sit down for an hour and not do anything?
Yeah.
Right. Not many people. You're going to be on your phone or watching TV or doing something. So this is the biggest con and this is the hardest part of trading. So it's not just exclusive to my strategy.
But I don't get why people find that so hard. Like it's really not. Like the logic of it is just like flawed, right? Like if you're gonna bet, essentially we're betting, right? We're betting that one team is gonna win over the other. Don't you want to be betting when it's fucking clear as day, or almost clear as day, that one team's gonna be winning, instead of like just fucking gambling and potentially pissing away your money on some like low edge trade? I don't know about you. I'd rather just fucking wait.
Important for my strategy though. So that's one of it. The second part is, so number 2 is the execution part. So once you can sort of deal with the waiting, the execution part is the next hardest part. So understanding
Why
the
is
level,
that?
right? Studying, doing your homework is also a difficult part for a lot of traders, right? They want to just show up and they want to just, click a couple buy-ins and hopefully make money. But you need to understand the right levels, right? And it's all in the preparation, right? In order to execute properly, most of the work is done before the market even opens.
It's very true.
True.
Right? So
True.
these 2 are pretty much the main cons, which isn't really.
That's why we're always
right?
planned and prepared, right? That's why you always say planned and prepared. That's why I'll have my charts might look fucking stupid, right? With all these goddamn stupid lines and whatnot on here. But that means I'm fucking prepared. I don't gotta know where the liquidity is. I don't have to know where all these imbalances are. They're on the fucking chart right here, right now. I already know what levels to have in mind to the upside. I already know what levels to have in mind to the downside. Multiple levels, not just the most immediate ones. I know where all the value areas are. I know where all the time-based levels are. So when the price gets here, I already know what's going on, right? I'm fucking chilling. People are sitting here fucking trading, stressing out, like, oh, like fucking popping Adderall, caffeine, like fucking sweating, no sleep. I'm just sitting here fucking chilling. Half the time I'm fucking faded. Chilling, right? Because I already know what's fucking going on. I'm not stressed about shit. Just fucking cooling it.
So many more pros to actually doing this, but these two can be easily fixed.
Definitely.
Right? You just need to sit down and objectively analyze yourself.
Definitely.
And put in the work, essentially.
So I think the one thing that people need to be aware of is that with the waiting and the patience, don't allow yourself to get complacent, because then that's where you'll miss the execution. Because obviously we're looking at this high probable trade idea that will only come not as frequent. And because of that, you need to make sure you're ready to execute. And that's why, as you say, the challenge of turning up still, but not executing until the time is right, is hard enough. But then making sure you are turning up, because then when the time to execute is there, you are actually ready and you don't miss that opportunity. Because if you miss that opportunity...
Well, in the case of the one he described at the start of the video, like, you don't need to show up every day, right? You kind of see what's coming from a mile away.
It's going to be a very long time.
But if you are actively trading, right, you do need to. That's why having alerts is like every single day when I come on stream, you can see there's like a fucking ton of alerts here, like going off every day, right? I'm not staring at these charts. I have alerts at levels, and when price gets there, I go look at the chart and see, do I want to be like taking this or not? And sometimes it's just for areas of interest I'm just curious to monitor, not even things I'm actively trading. So yeah, incredibly useful to use alerts, right? Because then you can be productive doing other stuff instead of just sitting here looking at the 1 minute candles for fucking no reason.
Before you get your next one, right? And that's considering the high probable play, especially in terms of, because at the end of the day, a trader like yourself and other traders who have built their reps in and gotten their consistency, you're still going to take the trade. But the beauty is you've built your reps, you have the capital, you have the risk appetite, you have the confidence to be able to execute other trades while you're waiting for this big trade. What obviously the new beginner trader, they could try getting a bit more active, but they have to be very, 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 very careful if they are going to do that, because a lot of the time it's coming from a place of rushing. So it might be a case where maybe the big trade like this that we've discussed isn't the only trade they're taking, but they're taking sort of a medium level trade, right? Which is still on a higher time frame perspective, you know, like maybe weeks versus years, or even months versus years. But not, I think the real guilty thing for traders, not only in options, but futures, Forex, like basic crypto, or any type of trading, is that allure and that sort of dopamine hit of just almost high frequency trading, but not obviously on that level, but scalping, day trading, when they haven't built the reps. You know, some people are suited to it, and as we talked about, like there's sort of 0.1%, etc., who are suited and can pick it up very, very quickly, but that's a very minute number. So it's understanding your personality as well sometimes, because some people might not be suited to be potentially the patient side. But again, it's all down to, you know, this whole concept of what we're looking at is trying to help a trader start really well, build capital without having to, because a lot of the time people talk about flipping account, like taking 5, you know, or 10K to 50 to 100. They talk about risking it all almost, right? While in this case, we're not talking about that. We're talking about still, you know, good risk, but in a way where the probability of the trade is much higher, and the trade itself allows for that, which is a different story, which is a much better story. So that's great. And then we're going to go look at some chart examples.
Probability much higher, and like how we were saying, the potential for gains is much higher.
Majority of you out there are prop firm traders. You're using prop firm, description below.
Everyone thinks that they need to be sitting here leveraging up on the 1 minute chart to make crazy gains, when the best way to do it is to just catch the high time frame swings. And you're just chilling too. Once the trade starts going, you're just sitting there fucking chilling, right? You're getting no stress, no nothing. Trades going your way, all you gotta do is just babysit it, right?
Now let's get back to the episode.
So we got the charts out now, and we're going to look over some chart examples of
1 sec.
Call low, dash line yellow, bounce too clean. Pixel tap twice, now they call it scheme. Said it ain't real, chart said please. Price don't lie, it hit my keys. Dash line ghost, still got weight. Chart come back like I said that fate. No fib, no tool, no glow, just space. But it hit 3 times like I own that place. Wick so tight, it brushed my mark. Entry hit like a sniper spark. You drop bias, I drop math. You use bots, I use wrath. Midday bounce, they call it fluke. I chalked that up when the week was new. Line been dashed since Tokyo opened. Price came back like I knew who wrote it. No back test, just blood and logic. They hit buy, I hit exotic. Price reversed like I flipped the plot. Not a thesis drown while I let mine pop. They said draw less. I said plot smarter. They call it imaginary, but the stops don't. Dash line yellow, bounce too clean. Pixel tap twice, now they call it scheme. Said it ain't real, chart said please. Price don't lie, it hit my keys. Dash line ghost, still got weight. Chart come back like I said that fate. No fib, no tool, no glow, just space. But it hit 3 times like I own that place. They don't believe until it hits. Imaginary, then why'd it bounce? Marcos. Yeah.
The concept that we've just gone over, so we're very interested in that. So what we got, SPX, of course.
Yep. So this is just a weekly chart here on SPX. This is from, we're going to focus on last year around May, right? So just looking at this area here, we had like a multi-week consolidation, about 3-4 weeks.
Yeah.
SPX back tested a key support level of 5,000, right? And like I said earlier, do you have to take the trade at the level to make money? Not necessarily. You can wait for more confirmation that the bottom is actually forming. So it took about 2 weeks, right? 2 weekly candles before we actually saw that bottom. And I jumped in around, I would say 51.50, 51.60 after we got 2 weekly candles of the market actually moving higher with higher lows. Right, so you can kind of see that there, right? We got that's initial sell-off, higher low, and then this is where I entered, right? So after I entered, right, I mean, we rode the market higher for about 200 points within 2 weeks, and I ended up making about a little over $1 million in the month of May. You can kind of see that there.
Yeah.
But yeah, like trading off these levels are important, right? But like I said, the market moves on news and data. So during the month of May, we got NVIDIA earnings, we had tech earnings, and NVIDIA, I think it jumped like 25% after earnings. And that was really bullish for the market because that's a sector leading stock and it's, you know, the leader of AI, right? And on top of that, we had data that the labor market was looking better and inflation was starting to cool.
Yeah.
Right. So having the earnings, right, looking at the chip sector, which is one of the big sectors in the market, and then you had actual economic data coupled together, SPX back testing a very key support level and holding. Those three combined allowed you to trade the upside, and I recognize that as many other traders did, and we were able to capitalize on that for eventually like a 2-3 week move to the upside before we topped out.
So in terms of identifying this as a support level, if we're looking at this candle here, where we actually saw price try to push down, failed to do so, and this is on a weekly time frame, similar the next week where we tried to push slightly down, failed to do so, and actually rebounded to the upside. When we then return, we're just expecting this level, and again, it's essentially just, is that 5,000?
5,000.
Exactly. Yeah. So again, back to your point earlier, extremely solid round number. We then, again, you're waiting for reaction as well. So not just the level itself, but then, as you say, you actually waited 9 weeks.
Very delayed entry, right? Interesting.
Patience we talked about, and that necessary patience, and not seeking the picture perfect peak bottom or trying to.
Interesting style of trading this guy has. I'll say that, right?
Trying to get in on the actual red candle that's then touching the level.
Yeah.
Of which then, if it closed like that, a lot of traders probably would second guess themselves, get out, or just mismanage, or probably not have real good trade management and probably get stopped out, only for them to probably the next week try and chase, probably end up getting in at the very, very top, probably suffocate the trade again. That next wick on the second, this wick here, probably takes them out again.
Yep.
Before you know it, we're in that segment on the right at the very beginning of the episode where we're in the anxiety.
Like I thought there's going to be talking about this as the trade.
Here, as you say, paying off. And then obviously a phenomenal trade, 7-figure trade.
Yeah.
So you can see to the right here, the level being respected once again.
Exactly, yeah. So yeah, it's really important, like, understand that reacting is everything with day trading. Like, you don't need to predict every move, and you need to understand that when you're trading. Having a strong bias when day trading, it can blow up your account.
Yeah.
Because you'll end up averaging down and then making up many other reasons as to why you should keep holding it.
Yeah, always.
Right.
Yeah.
So like me making $1 million in a month, like 10 years ago, I wouldn't even imagine something like that. But doing things the right way, like we like I showed you earlier, right? Building on the right fundamentals, it puts you in a position to be able to do this. And this isn't necessarily uncommon. I'm grateful for it, obviously, because the market's been really hard lately. But anyone can do this. You just have to do it the right way in the beginning and get the right type of knowledge in order to apply. And once
The fundamentals, right? As we called them in COD, you got to get your fundies right. Gotta get your fundies up. Then do whatever the fuck you want.
Definitely, just allowing that development as a trader to develop and build those reps, and as you say, over the long period of time, the money side, the monetary side, will always sort itself out when focused on.
And so I'll show you guys 2 more examples of some trades. So the next one will be.
I'd be curious to see what actual like options you took, because I'm assuming these are all like options trades, given the whole interview and whatnot. I'm curious like what strikes and expiries he takes on these trades. It would be more interesting if he had showed them.
Around the election time. Right. So leading into the election.
Because he mentioned like he was taking like weekly and 0DT options earlier, but I don't know if he was saying that in reference to these kind of trades.
And the market was very choppy, right? It kind of moved here near 5,700, dipped, a few hundred points, and eventually came back. And that was a hard time to trade from, like, I would say September, all of September, leading into November 6th, right? But like I said, the market moves on news, right? You need a catalyst in order to trigger buyers to step in. And after November, after Trump got elected, we had a huge gap up and the market ran for a month straight.
Yeah.
Right. I didn't make as much on this account, but still a very good month.
Of course.
So basically 5,700, I put 5,708 because that's the precise level, but these levels are a general range too. It doesn't need to be the exact number to the decimal point, but you could have entered at 57.
Yeah, like there's zones, right? Same way with these levels. Like, yeah, a lot of times we're like taking like the imaginary yellow lines, right? Yes, a lot of times those price bounce off these like fucking pixel perfect, but at the end of the day, like they're bubbles, right? All of these zones are really like bubbles. And you're seeing how price reacts like around the bubble. Same with like the value areas and whatnot.
Right? It doesn't need to be 5708, and you can still make a lot of money trading, right? So eventually, when we got that gap up candle, the market eventually topped out 6147, but within a month we got 400-point move, right? And waiting for the catalyst, which was the winner of the election, and then trading off the level, right? You're starting to see a common theme with the way I trade. Is you have to line those two up if you want to catch the big move. If it's just one of them, then you have to kind of trade smaller size and just take what you can from the market. But when those two stars align, that's how you make like the big bucks.
Definitely. And just to your point, would you say that really we talked about the 3 to 4 years on the examples we covered here?
Yeah.
But when we have a Trump market, would you say actually if you're keeping track and being alert and being tapped in almost to what's going on, you will get maybe not massive, the huge moves that we did mark out, but quite consistently moves like this will take place
for sure.
Due to just the nature of the volatility we see when Trump's in office and the things he's doing across the world, and a tweet, a post can really shake things up.
I like how it goes about this, right? This guy seems like quite efficient at going for the home runs when the home runs present themselves.
That just is actually more important. You have actually more opportunity potentially over this next 3.5 years ish, already 4 years, to take advantage of, as long as you're really tapped in and focused.
Definitely.
It might not be as big as the moves that we really covered, those really, really large scale moves, but still we could be talking half of that, quarter of that at a time, through quarterly periods basically, that are possible using the exact same simple system, but following that where the momentum's coming from. So as you say, identifying, okay, we have the election, here's our levels, and then reacting accordingly.
For sure, yeah. I mean, especially in the Trump market, he could tweet at any time and trigger like 100-200 point move in SPX within like a couple of days. So yeah, I mean, understanding the levels and just focusing on reacting to news and data is pretty much the bread and butter of, I would say, how most traders make money.
Yeah.
So everyone has a different style. Some use a lot of indicators. Absolutely nothing wrong with that. But keeping it simple like this and just being able to react the right way to news and data is.
It's a good way to put it. Who else did it? Who else mentioned this? Damn, it was so long ago. I remember the channel, but I can't remember the guy's name. But anyways, he used the same terminology. Like essentially in the video, the guy was saying that like every trader should have like one bread and butter setup in their playbook. Like one of setups that allow for these kind of trades. Those are the ones that are gonna allow you to like go exponential like crazy on your P&L curve. And we've been talking about this a lot, right? But you can see it's like a very reoccurring trend amongst all of these higher P&L traders.
Well, sometimes like when you have a lot of things on your charts, even if they might be helpful for you, you can lose the price, right? You can lose the actual essence of prices, which is I would say the foundation, almost the most important aspect of trading and the chart when it comes to technical trading.
Yep.
And
Interestingly enough, the other guy also did it like via options.
Seen it myself, I felt to myself, so many EMAs and drawing and lines and so many, to the point where you can't see the bigger picture. You can't really see the buyers and sellers anymore. Instead, you're just seeing all these things you put on. And there's nothing against them, but I think it's really important to have an essence of sort of good hygiene, good chart hygiene, because it will allow you to keep focused on exactly what's actually happening within the price.
For sure.
I say that the way I described it is like the charts and the candlesticks are like the language of the market. You know?
I agree. Yeah, that's very true.
I don't know about that,
so
but
last chart is, I'll give you one more example here. So this is the most recent one of the three. So we started to see some signs of weakness after that initial move from the last chart, right? The market moved for a month straight, and then we got roughly a couple weeks of consolidation, about 6 weeks of consolidation, and eventually, on this chart, SPX ended up filling the gap from the initial gap up from when Trump won the election. So trading off that level, like a gap fill level too, sometimes is a high probability trade for a bounce. But the market was so kind of, I guess, tricky in the month of January, leading into that eventual bottom, that I kind of scaled down a bit, right? Because it looked like a major top might have been forming. Because even before Trump started talking about tariffs or like implementing them in February, we all knew he was going to do it soon, right? So you have to kind of take it a little bit easier. And that's part of the reason why the P&L is smaller, but every month is different, right? Like if you look at all these charts, like there's no one month where you're making the same amount.
Yeah.
Right. There that doesn't exist unless you're, that good, but but I'm not there yet. But yeah, trading a gap fill and then buying there is another potential opportunity to trade for a bounce play to the upside, assuming you're in an uptrend. So I took calls on that gap fill, and the market ended up moving higher for about 2 weeks. So we had about 3 more weeks of choppy price action before the major top happened. But watching important gap fill areas is also another way to consider trading too, trading at certain levels.
I love that.
Another way to consider trading too, trading at certain levels.
I love that. And, well, Brando, it's been an absolute pleasure, and really thank you for breaking this down and really showcasing what it takes to have a high probable setup. And again, keeping it simple, and most of all, obviously, the catalyst that will bring the volatility, especially with these opportunities you're going to be seeing over the next 4 years. This is something you should really be dialing into. Now, links for Brando will be in the description below.
Interesting. We might have to give this a go, right? Next time we get some massive thing like this.
You may have, drop them in the comments. Brando, myself, will be taking.
It's kind of mini Black Swan.
Make sure you subscribe. Other episodes are on screen. Until next time.
Where's the other one? Oh, it was this one.
Back and forth, and it's just, it'll hit your stop loss and then go back in one direction. It doesn't even typically look like that. It looks like this, right? Making another high and then a lower low and then another higher high and such like that.
Yeah.
That's a seek and destroy profile. So the point is, how can we recognize days like this to avoid them, or how can we recognize days like
this one pissed me off when I first started watching. I was like, oh my god, man, like. Just not an equivalent rank.
this, so we can really take advantage of that and use that to really upscale our P&L.
Like, it really grinds my gears when people like this, like trading influencers and whatnot, go on these videos and say shit like this, like, oh, avoid range trading, gonna chop you up. Like, no, you just can't trade a range, so you get fucking wrecked because you know what you're fucking doing. But don't go just telling people that don't know better like these statements, right? Because like, think about it. Imagine you're like a new trader and you're like watching this person learning how to trade, and they say shit like that, and you just believe them because of what they said, because they're like a notable figure. When that might be your best style of trading.
Definitely. So like focusing, as you said, like ranges will 9 times out of 10 actually look like this.
So like, what days are accumulation days or low probability days most likely to be part of? It's typically a day where there's no red folder news events.
Oh, yes.
Like, if it's just yellow folder or there's just nothing, or even worse, if you're trading like a bank holiday,
Like recently.
the banks are not trading. Like, why are you trading most of the time? It's not going to be a good idea. Or a day after a holiday and there's no news and price is just accumulating for the next manipulation,
There's
basically.
no
And so
volume.
if you're trading that, then you most likely you're going to be the
There's like
liquidity, most
one hair
likely
on my
you'll be
beard. It's
manipulated
pissing me
out.
off.
But
Like,
that
it
being
didn't
said,
get cut
we'll get into
properly?
like there are days like you can take a trade here and there's different ways of approaching that, but there are different rules for that. So number 2, I would say it's like a day before a large high impact news event such as
Like FOMC,
Yeah.
NFP.
yeah, exactly, like a super high impact event, which is like day before CPI. I don't really love trading.
100%, yeah.
Day before NFP. Some people like the session, like the day before FOMC is also not really that great too much.
100%, yeah.
Most of the times I'll trade that, but I'll trade smaller size.
Mhm.
Day before CPI, I typically don't even love. I don't even look at the charts a lot of times. Yeah, but why? Because like price is accumulating before it's generating liquidity, and then the next day, you'll see during the 8:30 news, like typically it's something like this, and then just like a huge wick to the downside that knocks all these people out before the actual move. So I want to be part of this move here, not any of this, and then getting what knocked out there.
Of course.
So that's like 2 simple ways. Just looking at the economic calendar, right? Pretty simple.
Hey guys, just a very, very quick one. If you're enjoying this playbook and you want to get it sent directly to you, PDF, or to
It's a day. Yeah. Another possible day is it's a day after a large expansion day. Like we just priced the day before, just kept going, just dropping lower and lower and lower. And then now we just hit this monthly target where like a monthly liquidity pool, maybe it was a monthly fair value gap or even a weekly fair value gap. And hey, what happens after distribution? Typically we go back to accumulation. And now the price is just doing price discovery, right? So day after a really large move, I tend to just watch price action and kind of avoid. You can reprice, maybe sometimes you can reprice to the midpoint of this, like 50% of that leg up, if there's a good structural standpoint of that, where you see a bullish shift back up. But a lot of times we'll just accumulate and price will just move between the two. So I'm always cautious about that. I'll still show up to the charts, but I'm cautious of that fact that maybe, hey, yesterday was this huge range day and we just hit this really large liquidity pool. Like after a huge distribution, we could have accumulation again. And the point is just to wait for the next setup, not to mess around and find out, like I like to talk about on my stream a lot. So yeah, that's
But it's true, because like what you're identifying is the characteristics, the reoccurring themes of
Yeah.
when the market is not really optimum, as you said, like the low probable days.
Yeah.
And you can see that if you go to the no red folder days or the bank holidays, like just recently, or when we were recording this, just on Monday, we had a bank holiday. And the market was just choppy, just sideways. And then the next day, the volatility started to pick up again, right? And same with the day before news. You'll see the exact same thing, especially on like an FOMC day where it's all the way at the end of the day.
Yes.
Like during that day, you're just going to see range and choppiness. Yeah, and same with, like, as you said, a large movement after that. You might get, a day, maybe even a follow through, the 2-3 days of large movements. But once it's slowed down, and as you say, that's actually a really big key component, higher time frame, sort of fair value gap or order block, whatever it may be, or liquidity pool. That's a really good point, because this might be 3 days worth of price or like expansion. But once it's been hit, you do start to recognize price. It might go up, but it will just.
I mean, it would be nice if they expanded on the fact that this is due to low volume, right, and explained it. Kind of went into the nuances of that as opposed to just using this like vague garbage, but
and
whatever.
As you say, what does the accumulation mean? It's building that liquidity, it's building those orders, and then that's where we then obviously head over to the next one.
Right. Yeah. So what we talked about when it's hitting that like higher, like price just, this actually happened during the Trump tariff, like
Imagine.
when we were instilling tariffs, there was just huge down days. And this was really easy to trade because it was respecting these, it was making lower highs and lower lows. And this was a distribution period of price action, right? And then we actually hit this monthly FEG and even a quarterly like order block at level, like the midpoint of it. And then, so like, let's say this happened and then now we have this huge push up from this. This might be hard to trade now because now you have jagged ends on both sides. And I don't really love when price action has jagged ends on both the upside and the downside. And now you're sort of like in the middle of the range. Like, let's say this is a 4-hour fair value gap. Now we came back into at 50%, which I said earlier, maybe I'd aim for that after we hit this liquidity pool in the monthly, right? And now this is back to a 4-hour in around 50% or premium of this range. Now what? Like now we have a bullish one down here. It's like, yeah, we could retrace down to this one, and then we can, like, this is where accumulation is likely to actually happen. We can come down into this one, and people might be now going for this high. Like, and I'll redraw that. We might go down into here, and then people might be targeting this high. But the thing that you have to pay attention to is right now we might actually be in accumulation mode. We might be generating liquidity. So that means that we might not reach this high. We actually might make a lower high, and even just make a high or low as well. And that's the tricky aspect. Now we're generating liquidity. We might pause between 50% of this wick on this high, and a lot of times they'll take out another low and then take out that high, and then just, you know, this is a very difficult environment. It is tradable, but it's very difficult. And that's my point, is you have to look at.
It's not though. Why is it difficult? Like, you're taking a trade at the level of interest on the retrace, or you're fucking not, right? What is the difficulty in this? This is what I mean. Like, this is why I didn't want to watch this video, right? You can just tell, not the how do we phrase this? Not an elite trader, we'll say that.
There's 2 points of interest here, with prices just bouncing between a 4-hour fair value gap and like an hourly or another 4-hour one on this side, and you don't really know, hey, where price is going to, then it's best to stay out and just wait for that displacement to the upside, right? So I want an energetic shift, typically above a swing high.
We said this is where traders like
earlier.
waste trades.
Yeah.
You know, waste trades in those conditions, and by the time like the good displacement and the good trade comes along, their mental capital's gone, and then they don't execute on that, and that normally just revolves to more and more bad habits.
Yeah, exactly. So I'm paying attention to if we're especially if a lot of times we'll reprice at the top of this fair value gap and reject right there, and yeah, that might form a nice like lower time frame level, like short. But I'm very cognizant. I'm not going to just aim for this low. This is where people end up holding their trades too long, and then they end up getting stopped out because price is not going to be moving like that anymore. So if you're noticing this 1 hour or 4-hour FEG here, this is a good spot to take some profit. And then that's typically what I do. I'll take a partial profit, and then I put my stop loss somewhere here, break even, and I'll get stopped out on the rest, and then break even. That's fine. In those cases, I'm not holding for a home run.
Yeah.
It's understanding, okay, yeah, I'm going to take partials. Maybe I'll even be more aggressive with taking partials.
Yeah.
I typically always like to leave some percent of my position on, because just in case it does go for that low, I want to keep those runners running. And those are the cases that, you know, if you might get frustrated if you're not taking that partial there, and you might get married to your bias there and continue trying to short as it's retracing, and then you get stopped out, and now you're mad, and now you're flipping long here. That's exactly what blows up accounts, and I've been there and done that. You know, that's what you have to understand. This, like, if we might just be bouncing between those PD arrays, which are premium discount arrays. So price in a premium, when it retraced to here, now this is a discount of this leg here. So if price is just bouncing and doesn't really have a direction because of those jagged highs are making it harder, it's better to just let it generate that. So now, like, you know, if we stayed out of this and, you know, price retraced here, now it might be generating these equal highs that later on we'll get part of the move there.
Yeah.
But it's really hard to control yourself in these situations. And I think that's where traders go wrong. They marry their biases, and they sort
That's
of.
where amateurs go wrong, right? Say correctly. Those aren't fucking traders.
In one time frame, you look full bullish. The next minute, it's freaking bearish.
That's a great point. So like that's.
If you're sitting here flip flopping, foaming the trades on a low time frame like that, you're not a fucking trader.
Yeah, that's probably the hardest. It's like, okay, over here, okay, the 4-hour looks, actually, we're part of this leg that actually looks kind of bullish here, but here on the daily, we're still bearish. Now we're retracing this hourly, and that's bullish. And if it comes down to that, you don't have a clear bias, you don't have a clear drawn liquidity, then that's the best time to kind of just set aside and wait, or wait until you are more confident. That's it. If you don't know where price is going to, you're done. That's like one of the first things on the checklist I'll go over later. So jagged ends on both sides also that we talked about, this jagged end. I really prefer it. We'll talk about those equal highs and lows and other liquidity areas. But yeah, well, that's what there is. So it's hard to read structure on the 4-hour and the hourly chart like here. That's difficult. And that means that you might be part of accumulation. Especially what I look at, lack of displacements, right? Over swing highs and lows. So typically what you're going to get here, price is probably going to wick like below this low into this FEG, and then wick above. These are all wicks, and we're not getting any displacements through. Meanwhile, I want to get a nice push through with a displacement, meaning there's going to be a FEG on the hourly or something above this high. That's how I'm going to figure that out. Especially if we turned over this 4-hour bearish fair value gap to the upside and it broke a swing high, that's really indicating to me now we're bullish. And this is where I would want to think, okay, yeah, now I'm really looking for longs. I have a better point of interest here, up here, to go for. So if there's a lack of displacements there, we're not going above those highs. We're just wicking and returning back into the range. Especially, you can easily see this on the 4-hour, the hourly chart. It'll literally look like barcode action. So I'd rather just wait And it's hard because like that's a 4-hour chart you're waiting on,
Yeah.
or an hourly chart you're waiting on. You're gonna have to wait a day or something typically, or just wait until the next high impact news day, which is probably gonna be later in the week. You know, it's or another random headline.
So as they say, patience pays.
Yeah.
Patience pays, and trying to get involved when it is choppy. And I get it because like as a trader, you assume, or it's easy to assume, you need to trade every day.
Yeah.
Regardless of whatever, you need to trade every day. But
Yeah.
a lot of the time, that's what leads to you not having positive P&L, which is obviously then the opposite of wanting to be a trader and the result that you're trying to get.
Yeah, manipulate. Like the thing is, you can trade accumulation, but especially if you're a beginner to intermediate, it is not recommended. There are different ways. You have to go on a smaller time frame, and that's harder. It's probably gonna stop you out like once, and then you'll have to try again, and then maybe that second trade will work. But after that, I'm like, all right, if I'm wrong twice, sometimes I'll anticipate that it's gonna be a harder day, but I still have an idea on the draw and liquidity.
Yeah.
I'm still gonna trade that, and I'm probably gonna still, depending on the day, if it's a day before a high impact news day, I'll size down.
Okay, great.
But I'm still gonna take the trade, and then I give myself 2 losses during that session. And if I'm wrong, then that means I either don't have a good grip on the draw and liquidity, and I don't have a good read on the market, which is fine. Come back.
Didn't she just start off this interviews? Because am I fucking going crazy? Did she not just start the interview by saying that she doesn't fucking trade that shit? Didn't she go on like a 5-minute fucking rant about like no volume, banks closed before FOMC, blah blah blah? Now 10 minutes later, she's sitting here saying how she fucking just breaks her own rules and trades that shit with less size. Interesting behavior out of this character right here.
The next day. Or number 2 is like we're in a seek and destroy environment, which is the harder one of those environments where price is just taking out a high and then taking out that low and then maybe generating another something like this and then low and then high. That's a seek and destroy environment, right? If you're taking out highs and then lows, and that's just the easiest way to figure this out actually is seeing that price is most of the time like remaining in the middle of the range.
Yes.
We're actually not having any kind of direction. So that's seek and destroy, or FAFO. People that watch my stream know what we're talking about here.
This is a test of patience right here, not trading.
That's the harder
Holy
part
shit.
of that environment. That's the time where I'll take 2 losses and be like, all right, there's no direction.
Done, yeah.
Leaving the session. If I had a draw, if I thought maybe the draw on liquidity, for example, like here actually is great. If I thought that maybe the draw on liquidity is up here, and I saw, okay, we took out this low here, and now we had a market structure shift to the upside.
Let's take a break for a minute there, guys, because I want to tell you about our preferred prop firm, Apex Trader today. Now let's get back to the episode.
So yeah, this is actually a great example of maybe this is a time where maybe I would take a loss because this is maybe London low, and we took out this liquidity down here, and here we broke this short-term high, and I would maybe try to enter here, stop below this low to go for this buy side liquidity up here, this high in here, and guess what? I just got stopped out. And then price just surged up to that target, and that's frustrating. That's just the kind of environment you're in, and that's just harder, and that's okay.
You have to accept that.
You have to accept that. Sometimes you'll miss a trade. Sometimes, and again, that's why it's like more for more advanced.
Well, this is why I loved what you said. Yeah. So in terms of like being able to identify what's best for beginners, where to start from, what's best for them, the sort of more intermediate, and then also who's best in terms of like advanced conditions.
Exactly.
Because you don't really hear of that too often. To be fair, people talk about maybe advanced techniques when it comes to say risk and sizing and risk management, but you don't really hear it in terms of conditions.
Yeah, exactly. You just want exactly. This is the hardest of the conditions. Then there's manipulation where some people like to get involved there. I don't really get involved. So if we're just taking out this low, some people would get involved and just buy there before, and if they're anticipating a move up higher, and maybe they'll put a stop on this higher time frame, low down here. I like to wait for confirmation, and this is a little bit more advanced. This is where people call them like those turtle soups entries, colloquially in the ICT community, because this is it's looking like a breakdown. And I think I just watched your
what is that
podcast for Linda. I love that's her term for sure. And this might be this is a false breakdown essentially, but people are, if you're bullish, you're buying for the upside, and this is the manipulation, right? I don't really love doing that because sometimes it is a breakdown, and I'd rather wait for the confirmation. The distribution is again the easiest part because especially if you recognize this jagged end down here.
We're gonna try to contain ourselves, right? We're not gonna sit here for the next hour roasting this person.
So that's what we'll go to next. Distribution.
Definitely, yeah.
Yeah. So finally, we're gonna go into
try and contain ourselves. We'll use this as a mental challenge.
Red folder events. Folder event days. And like I've talked about this on my stream, like CPI is my favorite day. I'm not trading the actual release of CPI. I'm trading the New York session afterwards. So that's one of my favorite days to trade. CPI, NFP is not bad to trade either, but like even PPI, GDP, NFP I'll trade honestly. Again, but these are less trend-like days, so it's not the easiest. What else you have? You have like after FOMC, I'll trade that.
Yeah, definitely.
I'll trade the aftermath of it.
It's actually really
But
good. It's
this is
clean
my
at times, isn't it?
Yeah.
The CPI is your favorite.
Yeah, I think I mentioned this during the podcast, and like, I mean, we'll see. You could just go to my you can literally just go to my channel and you type in like CPI. I'm like, most of them are winners. Like, you know, it's just like, because that's my favorite day. Those are the days where I'll go for larger wins because we're in distribution mode and price is following those, respecting. I could move that stop here and then it's making a lower low and lower high, and I can go for that huge win where my runners really make me a ton of money. Like I've made 200 points, 100 plus points several times doing that.
Incredible.
And those are fun, right? Then we bring out the money gun on the stream and we have some fun a little bit. But that's the point, is that these are the distribution days are easier to trade, bigger winners.
Would you say there's more confirmation behind the distribution segment of it? Yeah, because you've already had the accumulation, you've already had the manipulation.
Exactly. Yeah, there's way more confirmation because you see the manipulation, and if you have a target in mind, then it's easier. So how are we going to figure that out? And the easy way to find the draw on liquidity on these days is that price is jagged on one end. Let's say, you know, this is a daily fair value gap, and it took out previous day high.
What a whip.
And now we're having a 15-minute time frame shift here, or even like a 5-minute, 1 minute, depending on what kind of trader you are. But we have a 15-minute shift here, and then
silver's still going.
Retracement into a 15-minute fair value gap. And the point is here, we already had that shift, and downwards down here maybe there's a 4-hour internal liquidity, 4-hour in a discount, which we're going to go for next, because we actually, with this leg back down, we never actually retraced to equilibrium of the range. And this I really like as a potential liquidity pool, even if if this previous swing low did actually reach into it, but didn't completely fill it. So we can draw that like this. But we took out this high into that fair value gap. A lot of times I'm actually looking for this, ugly, okay. A lot of times I'm actually looking for, this is a drawn liquidity, this is a short-term low with more liquidity beneath it, because we didn't actually completely reprice this here. So then I'm looking for price to come all the way back down here, and I'm entering up here, and like that's an amazing RR situation, and it'll get you like 200 points, you know, on the Nasdaq, which is fun. It's fun. It just simply is fun. Even when you're trading for like 5 years, like me, it simply is fun, especially when I'm watching.
Can't be that feeling, you know?
Yeah. I mean, it's just at that point though, it's not euphoria anymore. It is more of like a
you did a great job,
Look,
because at that point you'd wait,
exactly.
wait if there's been patient and you executed properly. And plus, you know, at the end of the day, most people, they're not profitable in the market. So if you're able to be profitable, that feels good. Especially as
can you guys see the difference, right? Can you see the difference between this person and then like the options person? Can you see the difference? It doesn't have to be said, right? You just know. We just fucking know.
You know, at the end of the day, if you're able to consistently be able to hit these sort of trades, and even if they're not every day, you're hitting those home runs, if you will, or those base hits. Sorry, I think they say that. You're hitting those base hits, and then you finally, get your distribution done. You get your home run. Of course, it's going to feel good, you know.
Exactly. Especially if you've like waited. If you waited.
Especially with live streaming as well. You got an audience to watch.
I know. That's where part of it is. Yeah, it's fun. It's part of the fun, of course. But yeah, that kind of, I'm looking for that in liquidity oftentimes, especially like if we have this imbalance and we made one short-term low here, but we didn't completely reprice this, and everything's looking good on the lower time frame, right? This is how this looks like on the 4-hour, the daily. But if you go to the 15-minute and you kind of like zoom into this area here, and that's typically where you're going to see the accumulation mostly, which is like, day before CPI, you're seeing this, and then during that 8:30 spike, that's happening, and then we kind of retrace, and then we're dropping, and then you get this clean continuation lower. And that's basically how it goes.
Because the key points here is that you're looking for this AMD, right?
I was looking at her channel out of curiosity to see like what kind of trade she puts on. Out of curiosity. Very small position trader. I was gonna say I highly doubt this person is able to like scale an account to any like meaningful size doing this, right? Makes sense though.
Yeah.
Given what we're seeing.
Yeah.
But it's understanding the context, right?
Yeah.
So you have your daily, the manipulation will hopefully take us into here. You've also taken out obviously a prior high, might be a daily high, might just be an external liquidity, and then you're looking for this. Rather than a lot of people make the mistake of like, this is a great concept, let me go look for it, and they're looking for it here.
Exactly. Yeah, exactly. They're looking for it here, and they're kind of many times they're not realizing, okay, we just dip down into here, and we have this daily tap.
I have
we
to
this
speed
daily
this
buy-side
up.
liquidity that hasn't been tapped yet.
Exactly.
And yeah, you might get wrecked there.
Exactly. It's the positioning alongside of obviously keeping track of which part of the market we're in.
Yeah.
And we have to be going for the distribution, but it's understanding that this pattern, if you will, this concept will only play out. Well, not only play out, but the best times for it to play out and where you want to be interested is in these high time frame areas after liquidity's been taken or displacement's taken place, so that you can then look to capitalize on them. Because again, people will each day, let's say this is like 3-4 days worth of price action to get to these highs. Each day they'll be looking for it. Each day they'll be looking for it. Versus like if you save yourself, as you set out from the very beginning of the episode, for the high probable days, that's where you're gonna have a much better time. A much better performance hopefully overall, and it'll feel better as we talked about just now. Like that's when it'll feel good. Versus the problem is if you do this like each day, you take a loss. Even if you end up taking the win, you won't feel good because you're probably just covering the loss. Exactly. And it feels like a waste of time, right?
Yeah, exactly. So it's this part is where you're really building discipline. That is where like champions are born, I would say.
That's great.
You're forging, warriors are forged in that time. Yeah. Okay.
Amazing. So we go over the pros and cons now. And just to make sure everyone's clear, cons wise, we don't mean it's like a bad thing. It's normally just like a hurdle or something to be aware of. When it comes to implementing this style of trading or this strategy. Do you want me to cover the cons side?
Yeah, sure. Like pros.
My very poor handwriting in comparison.
Okay, so the pros, it gives you an easy like checklist to check each morning, and we'll go over that checklist and give that to the audience as well. It's pretty simple, and it's an actual just logical thing to follow in the mornings to say, hey, are we potentially in a high resistance environment where it's a lower probability day, or is it potentially going to be a nice clean move? Okay, so that's one. So that's pros checklist, like that checklist in the morning. A con is, we talked about sometimes price actually like doesn't manipulate and it'll continue running without you, and you might feel FOMO, like just continues without the manipulation, and without even retracing or anything, and then controlling FOMO is difficult. So you have to staying disciplined. Disciplined, I would say.
Let's take a break for a minute there, guys, because I'm going to tell you about our incredible sponsor, TradeZeller. TradeZeller is the #1 trading tool in the entire trading industry. TradeZeller allows you to become a more you have onto the dashboard and see the description.
Another pro is like you can anticipate a difficult day before it even happens. Like it happened on my stream this week. Has been a little bit difficult because you have like a random headline and then it takes out my buy side liquidity target, and I'm like, oh well, I wanted like this is basically what happened this week during my stream. Like okay, this is the buy side liquidity that I think we're going towards. I would prefer it if we take out this low first and then take out that buy side. And price actually what ended up happening was we just we went down a tiny bit during 9:30, and then there was like a 9:37 a.m. random headline that just popped NQ up like 146 points. Got out, and I was like, okay, well, that's scratched. So that ties to like FOMO. You have to control that. So I think that's a con, is like FOMO is a potential thing you have to definitely control your emotions for. But other than that, you can anticipate a difficult day, a barcode day.
A low probable day.
It's a low probable day. And same thing, you can anticipate a potential banger day, is that what we call it?
A really good day,
where you have like large amount of points.
High volatility,
Points, captured,
And just for the con side, it might not present an entry, right?
Yeah, that's exactly. Sometimes no entry, especially if you're waiting on a retracement, you're a retracement trader like I am. Sometimes that happens. It barely retraces and it just goes straight for your target, and you just have to accept that and wait for the next setup, and that kind of sucks. But that's just gonna happen. If you have a long trading career, like I always think that in the higher time frame of things. There's gonna be so many days where I take a trade and it stops me out break even, then it flies to my target, or there's a trade and I don't get an entry and then it flies to my target. That actually happened the other day. I missed a limit fill by like maybe 5 points or so, and it shot up. But like, what can I do? It's not my process to wait for that retracement, because when it does come to that limit fill and it wicks it, and I get that sniper entry, that's delicious. Nothing beats that feeling. But so in those days you get a large amount of points captured, and you feel more confident holding that because you've done all this work of noting these potential days that can happen. Like, I don't know, miss a move. Sometimes you'll miss a move, no entry. Trending day, no FOMO, and sometimes you'll be wrong. That's not 100% win rate. You have to make sure that 2 stops and.
This is literally like applies to any fucking strategy on earth.
Win rate for my CPI, but it's pretty good. It's like probably like 70-80%. And there was like one recent one where it was a high resistance run during the morning, and then after 11 it started really distributing. And nothing's 100% win rate, of course. But that's why I say like 2 losses and you're done, because you just gotta accept it. Otherwise you can really start
3-4.
You're done.
So it can be the case where the accumulation, you're expecting it to manipulate and then obviously distribute, but it just stays in that accumulation phase. And if you get kind of attached to like it needs to manipulate, it needs to distribute, and start, so sometimes it's like it's not ready yet, and you just have to be patient.
Is that just something? Are they like? How does she come up with this number 2? Right? Is it just some arbitrary number? Did she test her data and see that after 2 losses trying this, the win rate goes way down? Is there any explanation for this, or are we just saying fuck it? I lost 2 trades today. I'm not trading again.
You're done.
So it can be the case where the accumulation, you're expecting it to manipulate and then obviously distribute, but it just stays in that accumulation phase. And if you get kind of attached to like it needs to manipulate, it needs to distribute, and start, so sometimes it's like it's not ready yet, and you just have to be patient.
Just a second manipulation. Like, sometimes that'll happen. And price doesn't always move exactly the same way. The point is finding a potential process and just follow it through and let the probabilities play in your favor, so that your wins. That's the point. Like your large amount of wins, like points captures, totally makes up for any little paper cuts that you might have taken during accumulation area, because you're not gonna always predict it perfectly. So So we talked about earlier about the checklist. So let's go ahead. Okay, checklist. So number 1 is checking the economic calendar.
Yes, definitely.
News events.
You'd be surprised how many people don't.
I'm telling you, when I was a newbie, I did not realize what FOMC was. Like, I was like, what is everyone talking about?
Why is the market moving?
Exactly. No, seriously, if news events, and for that you can easily just check, Forex Factory or investing.com. There's many different free options for that. So other news events are the red folder. What is this? Okay. Okay. Number two, I think that's actually we didn't touch upon until now, but like, are the markets correlated? And I'm talking about like Nasdaq and the S&P 500 and even the YM, the Dow Jones in this context. But in other contexts, you could look at the pairs and that's typically correlated. So are the markets correlated? So typically, I want ES and Nasdaq to look similar in structure.
Course, yes.
And sometimes they're not. Sometimes, like, I think the worst, this is a tip, sometimes the worst situations are the Nasdaq's looking quite weak, while ES is like ranging and looking kind of bullish, and that's weird. And then meanwhile, YM is like really the strong sister there. And then you're like, all right, well, what? You don't know what to do. Sometimes like, oh, ES might look like a bullish situation in that sense, and this is actually a pretty low probability situation I'm talking about right now, is if ES is a bullish scenario, a lot of times it will retrace and then, oh, Nasdaq is really just pulling it down, it'll pull it through, and then maybe it'll start correlating afterwards. So if you had actually waited for that, you would have been in a much better situation. But sometimes, especially after a large range move the day before, that's going to happen where they're not correlated. And that's where those divergences where, oh, Nasdaq took out.
Okay,
this low
well,
market,
since she's not going to expand on it, I guess we'll do it, right? Obviously, these indexes represent the set of companies, right? So there are going to be many reasons this is occurring. If we're seeing some like a high tech related growth sell-off or rotation out due to like tech fear, then yeah, this is more likely to happen. Or if we're seeing, for instance, in the recent FOMC, right, like what benefits from lower rates, a lot of the lower small caps, and you see this start to outperform. So many reasons this is going to occur, right? They don't have to be operating in sync. Also, you can monitor the order flow for these individually to monitor what exactly is going on, not just looking at the naked chart and saying, oh, they're out of sync, not going to trade today. But in the ideal world, right, Nasdaq is the highest beta. So if the market is going to trend strongly one way or the other, you want it to be like Nasdaq trending, leading the trend, and then ES, and then this, right? Or vice versa to the downside. Typically the variation when it's in a healthy trend one way or the other. But there are various reasons why these can become uncorrelated. Doesn't mean you can't trade them. As long as you're aware of what's actually going on behind the scenes, not just looking at the index itself and not paying attention to what they're comprised of.
Did not. So let's draw that out. Actually, it's gonna be good. And those are situations that maybe like when people look for divergences, they look at for, oh, Nasdaq took out this low pre-market, but ES did not. It remained higher. But then you see very quickly that there's divergences on both sides, and you're going to see, oh wait, like Nasdaq did not take out this high, but ES took out this high now, and then that's where it starts getting confusing. You're like, okay, this is those situations where looking for divergence for a potential reversal situation, where in the past maybe you would look for that, oh, that's potential manipulation to go higher.
Yeah.
That's not going to end up working out because they're just not correlated. They're just going to continue like this, like that, and that's where SMT's smart money technique divergences won't work. When the markets are not correlated, then that's not going to work. Yeah, so that's a tip there. The markets are not correlated, you're gonna have a hard time.
Definitely.
Because those are ES and NQ are sisters, and they should be. One of them's always a little bit weaker and stronger. The Nasdaq will move faster, and Nasdaq will typically take out those lows and highs because there's just more manipulation and it moves a lot quicker.
Yeah.
But if they're not looking structurally similar in that fact, then yeah, that's what's your idea really based upon in that sense. Well, the third thing is obviously a draw on liquidity. Can you frame a draw on liquidity? Can you see where the market is likely heading to based on what we talked about on those structures, equal highs? We're aiming, that's manipulation, we're aiming for those equal highs or some other buy side above or fair value gap above. Do you have an idea where the market's going to? If you don't, then it's best to sit back with the point. You don't have a trade. Please do not try to make something up on the 32nd.
Oh wow, I remember those days. I say.
And yeah, so that's what we're talking. I'm gonna talk about the drawn liquidity a little bit better. Then, so
ideally, we're doing it a bit more data driven than that, right? We're not looking at a naked chart and saying, oh, equal highs, therefore liquidity is there. Right? You can see the order book to see where resting orders are. In crypto, you can see heat maps. You can see all the options levels, all the gamma exposure is for any instrument you're trading on the traditional market, so on and so forth. So yeah, maybe don't do it in this simplistic of a manner if you want to be efficient.
Or equal lows, or like we were talking about an imbalance on a higher time frame. So like a 4-hour FEG maybe or daily FEG, and then what I talked about before, like those short-term lows with liquidity below, liquidity still below, or short-term highs with liquidity above. So that would look like. You have this FEG here, and you got that high, and that's a short-term low, and it didn't fill this in yet, so that's a potential liquidity target here. Or with highs, short-term highs with.
With that said, if you don't have any of those tools, can't afford it, this is going to be your best bet. But just understand that you're being like quite inefficient.
Yeah.
Short-term for the short-term high would be like, and then we took out some liquidity here, and then we have a daily FEG above this short-term high. It only filled in a little bit, and now price is bullish. We just hit this other level, and this is my liquidity target up here. I like those as well. But if everything's kind of difficult and you're wicking both ways, that's a clean, obvious way that there's not really a price action to go with.
Definitely.
So so that leads me into the next thing, number 4 actually. Yeah, number 4 on the checklist is displacements, right? That we were talking about before.
We were, yes, yeah.
You want those energetic shifts. we want those energetic shifts in structure where highs are taken out with displacements. So this is like an FEG. It's a clear potential area for us to continue up higher versus us just kind of on the lower time frame, just going to look like this. It's wicking that and then reverting back into the range. So that's important to take note of. And that also leads me to here is like our FEG is being respected on the higher time frame. So if this wasn't respected here on the higher time frame and it just kind of dips below and then it makes like a bearish one, let's say it dips below that hourly fair value gap. So I'll redraw that. And now we have a bearish FEG there. And some people call this like a BPR area, like a balanced price range area. And then so they might be looking for shorts, but we looked at overnight. We didn't even respect that either. That's showing that FEGs are not respected. And so that might be a difficult market because even on the higher time frame they're not being respected. Then why should they on the lower?
Yeah, that makes sense. Yeah. It's a great checklist, and I think it's important to be able to come to the market. You have your sort of plan, even if you're not using the concept that we've gone over today. It's still important to have a checklist that matches the conditions of your plan, right? So then that way you're answering these questions and you already know, and it allows you to do exactly what you set out to do today in terms of identifying low probability to high probability days. I think it's important to do that because otherwise, if you come into the day and just freestyle, you don't really have a checklist, and you're not really trying to identify if it's a good condition day or not. It's easy to kind of treat every day, as we talked about earlier, just treat every day as a trading day, and waste capital and mental energy on trades that just are not worth it.
Exactly. If you're like trading every day looking for a home run, then you're likely not going to find it because most of the times price is not trending. It's like I'd say like 30% of the time, 20 to 30% of the time price is trending, and the other percent it's ranging. And so if you're going in every day looking for that home run, then you're not going to find it most of the time. Exactly. And if you're confused about price, basically what we say is like if you can't figure out the drawn liquidity, then you are the liquidity. That's a great thing to remember.
It is, yeah.
So yeah, we can just go ahead into examples, I think.
If you go on the charts, you can see this there. Amazing.
Let's take a break for a minute, guys, because I want to tell you about our incredible partnership with PropFirmTrader.com. Majority of you out there are prop firm traders. You're using prop firms, so leverage is in the description below. Now let's get back to the episode.
So this is pretty much an example of this easier distribution day. I took this live on my live stream. This is a CPI day. And you can literally see like this is 8:30 and this is a news release. So you can tell even when you're backtesting things that you can easily see without even checking that this is a news release day. And this is a manipulation leg. And I waited for, you can see before, obviously this is accumulation, pretty much what we just drew out. Manipulation, right? And I waited for more confirmation here. I waited until it broke a swing low with a fair value gap. This is pre-market still. So this is after 9:30. And yeah, this is where I was able to trust the market structure because I managed to understand this is a manipulation leg. And now I was able to see here, okay, we're respecting these swing highs, and then we broke this low with a fair value gap.
Didn't we have a short on this, like on stream or in the Discord? What was that? No, okay, we wouldn't have been streaming by then. It's funny because I vividly remember the day she's talking about.
Here. And I could have just shorted here. But in that situation, I think what happened was there was a 1 minute FEG here, and this is still in a discount of this leg, right? It's below 50%. I would.
This might have been the day that I was talking about that whipsaw story.
Short here. Trusted the stop up here. I personally just waited for us to disrespect this 1 minute bullish fair value gap here to invert it, and then I just entered, and I put my stop here because I believe that was going to be rebalanced to this fair value gap, and I believe this was the next swing high forming. I took some profit here because that was over 2R, and I waited until distribution down here, and I was able to take a lot of money from the market there. So I made about, I think, $2,600 there, shorted here from 20,850, and I took the rest off at 750. So that was a 100-point trade on NASDAQ.
In 15 minutes.
Yeah, in 15 minutes. That's what I say. It's like the easiest trade to do because it distributes the fastest. You're never really in any kind of emotional drawdown as you're waiting for prices consolidating, and it's the worst if you're in a break-even trade and it hasn't moved. Those are the harder environments. But here,
you can see if you go down as well. If you go down on the trade seller here. Doesn't scroll down. If you scroll down here, then you go on the charts and running P&L. This is what we love to see.
Exactly.
Minimal drawdown, like a minute or two, and then straight into profit. It's incredible.
Yeah, exactly. So you're not really holding your breath for a long time.
No,
So those are the best trades that work out for me. As I noticed, I'm in profit like immediately, right? So for here, the entries don't really matter nearly as much if you're in a distribution mode. Whether you're going to go for that retracement above 50%, or whether you're going to go for after an inversion, or maybe another swing low gets taken out and you can get in. It doesn't really matter nearly as much as you know the direction and you know where to put your stop as long as it's a good RR. And you're good to hold for further targets, right? So I took a little partial here at that new low day. After it broke it a little bit, and then I took the rest off here, and that was that trade. It was pretty easy. Like I said, just pretty much how we drew it out earlier, which I love. And this was like quite the manipulation, but you saw that huge retracement and then started breaking lows. You can recognize that.
And it's great how you waited for that displacement and wait for that low to get there instead.
Yeah, exactly. With this, I typically, I think right here was probably divergence with ES, where ES didn't take out as high,
that makes sense,
which we talked about before, where the divergence will work out. And personally, a lot of times I like to wait after 9:45 to enter. This was during the 9:50 to
that OBS issue happened.
Silver bullet entry. Yeah. Basically, so typically why I waited a little bit here was to I wanted more confirmation. We kind of had these equal highs here, and typically most of the time I'm actually waiting for after the first 15-minute candle to form a lot of the times. And you see that we did like kind of wicket. We still didn't take out this high here. And we did
should be good, yeah.
Low from that CPI surge higher and pre-market lows, but this was pretty much indicative here. We didn't take out this high with a displacement there, and then we completely dropped below this one. So this looks like a clean manipulation to the upside. Is my point.
Especially with the accumulation before as well. See, it's quite extensive.
Yeah, exactly. So that's one example. And then we can just go to the next example. Is actually a bullish example.
Nice.
It's actually the next day, I think. Yeah, this is the next day PPI. So that's another 8:30 news release here. So here, that day CPI did drop quite a bit and ended up taking out this daily low and into a daily FEG, into a daily fair value gap. And we had this huge, like I said, this huge push down lower. And we started showing even before the New York opening session bullishness. So this is where I would look for potential retracement into 50% of this leg. If we go to the hourly, this is an hourly fair value gap in a premium. So here, let's just check that out. You can see again here, this is a news release. PPI, this wick below all these lows here. Again, accumulation. And this is the day before, by the way. This is kind of ugly, especially. But before, it's like, well, actually, the day before was that huge drop, and then it hit that level, and then the afternoon session, the afternoon session started chopping. Asia and London started chopping, and then you see right here, this is on the 1 minute. That's the 8:30 news release. Ooh, Okay. That's the 8:30 news release, a huge wick to the downside. A lot of times, yeah, I'm thinking that's the manipulation leg, especially on those kinds of days.
Yes,
We're looking at the 9:30 open here, and I actually had no idea what we were doing. I waited until up here to get involved in my longs because here I didn't really love. You see all these wicks, and there was no clean.
I mean,
I want that high here.
let's add some context to this because she's clearly not addressing some of this stuff, right? We know how these events work, right? There's 3 stages, correct? There's a futures reaction, and there's like the U.S. market open reaction, and then there's the 10:30 reaction, right? These are the 3 key times you want to be watching on things like this. So for her to just assume that like this initial reaction is going to be like the initial fake out and then just runs from there is not the case, right? A lot of times you see the complete opposite happen actually.
Personally, and I really like if FEG lined up with it. It broke this high anyway, actually, and there's no bullish fair value for me to get involved here. Upside, again, after.
Like usually they
again,
whipsaw
here, we took
both
out this low.
sides.
From this leg, we manipulated here, took out this low, and I knew that I had more upside targets here on the hourly. For the buy side, when I looked, this is important. You're looking at hourly and for like 4-hour typically targets for if you want large moves, right?
Course, yeah.
Right? If you want large move, you're typically looking for that as your target. If you're looking at a 15-minute or small time frame, that's fine too. If you're entering on a smaller time frame, but how I like to line things up is 4-hour or hourly point of interest for targets, or even higher daily and weekly, where you really get those huge moves. But for my entries, the structure shifts on the 15-minute and then entries on the 1. So you can actually see here, we made a clean 15-minute fair value gap there at 9:45, and then this is actually a huge thing right there. Yeah, we came back into this 15-minute fair value gap that displaced above these pre-market highs, and we wicked that, and I anticipated, okay, that's manipulation, and I'm going to get into this inverted this little 1 minute.
You see that displacement? Yeah, that's a strong buy.
Just is there a rectangle?
Normally it's
scan box.
The way the brushes are thing. Yeah, I'm just there.
Oh, perfect. Yeah, let me put that as a favorite. Sorry, thank you. That was good. Okay, so yeah. Oh, I love that purple. I'll put it as purple. Purple. Oh yeah. So that was clean. That was a 15-minute sweep liquidity retracement into that 15-minute fair value gap, and the price looks super bullish. And I anticipate that's manipulation. We have this little inversion here to look at there. This tiny inversion. So I actually just entered at the closure of this candle, or you could wait for that retracement into the 1-minute fair value gap created here, and that was actually nice. And I really noticed here these wicks were beautifully wicking and holding the upper component of this.
Yeah.
And that again, if we look down to that running P&L, like how much drawdown was I really in? Negative 100, right, for 1 minute. And then here mostly upside, right? So those are the easiest.
Again, like what?
Valid days.
It's probably like 10, maybe less than 10 minutes, $2,200. It's incredible, Or to the end, we got.
Yeah, exactly, yeah. Yeah. So how many points was that from? And this was like, not that points even matter. The RR always matters, but
yeah,
but you could see there with your winners going being much larger. I mean, with the loss being for such a small amount of time, you already know you're on side when something like that happens. By the way, that's how I reprice a lot of times. Like after I enter. That's how you know you're in a high probability environment, actually, is how long are you in drawdown for? If it's only a tiny bit and a tiny bit of drawdown, it's more likely you're on the right side. It actually gives you a lot more patience to hold to the full target of your trade. Because if you know that and you're noting that, and you typically know, like you saw in the last trade also, it was like 15-minute trade. I know my trades like that are typically 15 minutes long. I'm not going to cut it at 3 minutes and it barely moves. Exactly. Or even if I'm in slight profit at the 5-minute mark, right?
Is that where like the reps and the data really helps to be confident?
Yeah, that's where I'm, exactly. Really noting that all the time. Like, how long does a type price typically take to go to my target in these easy liquidity run conditions? And then noting, okay, also in this environment, once we leave this and we make a new high, then I can trail my stop to this low easily. Then I'm fine with that because that's a low resistance liquidity run environment in those like high probability conditions. It's going to respect that low that it just made before the swing high.
I love the inclusion of the 15-minute fair value gap there as well in terms of like then having another manipulation to continue higher. It just shows the layers because it's not like it's complex. Not like you're going 5 minute, 15, 1 hour. It's saying, okay, we've had the manipulation, we haven't managed to enter down here at the lows. We've now seen displacement, and now what can we see? And it's just a simple step of okay, here's a fair value gap. On the lower time frame, we've then seen a displacement and sort of the buy step back in. Now we have a fair value gap to enter from, and then we're just looking for our move, right? And within 15 to 20 minutes, we have our move.
Exactly, and that's what I'm talking about. Like those are the easier days to trade because really it didn't require too much thought from me, and price showed its hand already with that manipulation. It showed its hand with that beautiful displacement to the upside. So it gives me more confidence to enter and just hold for the trade. I think a lot of people might have trouble holding for full targets and things like that. And they ask, like, how did you hold for this much, etc. So that was a good trade as well. Yeah. So next, let's see here. No, this is a different day. Yeah. So this is another day. Let's see here. I think this was GDP. Yeah. This was. Let's see. And again, like this day actually a little bit difficult. This day at GDP release, it kind of went to both sides there, and then we started surging a lot higher at 9:30. This is actually kind of cool. I don't know. I was super patient in this trade because I went until the 10:50 macro, just 10:50 to 11:10, because I suppose I didn't have like a clean drawn liquidity beforehand. Yeah, I think I was bearish actually. Yeah, this is an example where I'm bearish, but price is not showing me any kind of entry here for bearishness, so I'm waiting. The third trade here, this is I think GDP day. And I just basically, I'll have session highs marked out. This took out previous daily highs, Wednesday high at that peak, that surge there. And it looks like I waited for a good amount of confirmation here for the downside during the 10:50 macros. When I talk about those macros, those are like the endings of those hourly candles. So like 9:50 to 10:10 and start of the next hourly candle. So a lot of times there's like theory about like, okay, that's the end of the distribution and going into the next hourly candle, and you're getting into that forming essentially. And those are pretty good hotspots. It seems like those are some good, those are my favorite kinds of trades, and those are really silver bullet, nice entries. And here, yeah, this is the GDP, and it looks like we wicked both sides. And that over there, that's like pretty directionless. Like that doesn't look like that clean of manipulation. Afterwards, here, there's no distribution. Here, it does seem like it could have taken a long here if I was still bullish, but it seems like here, looking back, I was looking for some shorts there, especially after we cleanly displaced below this low here. So after it took a daily liquidity level up there, it did have a nice displacement here to the downside. And these are equal lows from pre-market that I went for there. And then this is a data low. I think that's probably where I went for the second. We'll find out actually. We'll see. Maybe it did hit it, or we'll see where I took that last profit at. So that's kind of cool that I did end up taking near the low there, 9:57. it's pretty close, maybe like midpoint of this where I took off that last runner. So essentially, yeah, I waited until that clean structure break to the downside after if you're bearish, you know, over here, I'm looking for a low for displacement. This would have worked out actually, but I don't think probably it was risk-wise. This was clean. When you see those large down closed candles.
Exactly, and you're sweeping the lows to the left as well.
Yeah, those equal lows to the left after jagged highs. That's probably like a day where it wasn't as clear at the beginning what my bias was because I waited quite a bit. And let's see here for this, it did consolidate quite a bit.
Yeah,
so
not like the other straight to targets. That's the reality, right?
Yeah, it did consolidate, but like again, the
minimal drawdown there.
Not too much. While the distribution was definitely worth it there. So looking at that, that's a jagged high. Yeah, and having a jagged low here, but this took like a daily high on the left.
Yeah, is that example you drew out earlier?
Yeah, exactly, just like that example. So waiting for that displacement below more lows and seeing these equal lows here and a data wick low. Sometimes you see that kind of, I'll just make this larger here. If you see this wick low here, that's oftentimes also an area I would go for my targets. I think I probably let go of this after seeing that it came really close and I'm just like, all right, that's good enough because I did take it off here just before that. And I just was like fine with that. But maybe later on I did end up hitting it, but that's the whole point is like you're waiting and you're taking your partials here and then trailing. So then after distributed to here, then I put my stop pretty much break even at that point, right? Because it should not, if it's actually a good low resistance environment, then this high that took out the swing low should remain intact. So I'm then moving my stop there. And let's say I didn't take that off, then I would be stopped in profit or break even on the rest of the trade. Looks like the rest of the day actually did chop around. But that's the point. It's kind of being like, okay, then we're not continuing lower for more lows after that. And that's fine. You took some money off the table.
Yeah.
But yeah, that's pretty much it. You take out, you look at the jagged highs and lows. And you know, if you're still bullish here and maybe some people entered here for that, I think that's fine. But or if you're bearish, there's some other entries too. But that was my trade. Is that I waited.
What matters is that you have your system, right?
Yeah.
So that you could always find a way to be in that trade. Every trade,
exactly.
and that's what some people make a mistake.
Yeah,
of.
I typically will review other things on my stream. That's what I'm talking about.
Yeah, I can imagine.
Like I was like, okay, these are the trades that were there today, that day. But the point is kind of, you know, even if you took a loss maybe on thinking you're gonna go take more upside, and that'll happen on my streams as well. Sometimes I'll think like, okay, this is taking this high out with a displacement and, you know, going on that retrace, and that's totally possible. You know, then you're actually making up your money on the downside, you know, on the flip side after you see that. That's why I'm saying like, okay, it's okay to take a second trade, it's essential.
That's
yeah, exactly. I'll put my stop where the market structure shifts, right? So at that swing low here, after we broke that with a displacement, then it was clear, okay, we're going lower.
But luckily in this case, it was just a short.
Yeah,
and then back.
But anyway, it did.
But it makes sense because obviously having that two trade rule allows for that. Number one, because equally in this case it could have maybe popped higher, hit stop, and then continued lower, and then still gives you another chance to get back in. But having that two trade rule is good as well because if you do take two stop losses, it's also controlling, making sure you don't have further downside. Just be able to come back the next day, fresh slate, or wait for the next AMD to form and take it from there. But phenomenal free trades there. You know, all showcasing the exact model from what we went over, showing as well how, to be fair, what the beauty of it is as well.
Arbitrary rule, right?
The same trade in terms of the concept. But
okay, this thing's done. We're turning this shit off. That was such a test of patience. It was unfucking believable. Holy shit. Are there any pros you should take away from that? Yo, we literally wrote 0 notes to that video. Might as well just delete that section, right? It's a very like a beginner way of trading, not data driven, inefficient, never gonna scale an account to large size doing that. Also doesn't seem to have a very deep understanding what's really going on. Seems like they just learned a bunch of setups and terminology and just kind of run with it. Like, oh, there's a fair value gap, but what is a fair value gap? Why is it there? Like, does she actually understand these things? I don't think so. At least judging from that video. Maybe your streams are very different and they go much more in depth, but didn't leave a very good taste in my mouth, right? And we knew this from when we started this video the other day, when the first statement out of her mouth was already such a massive red flag about range trading. Right away, I was like, okay. Okay. That's the thing about level of trading, right? Within like fucking 5 minutes of hearing someone talk about this shit, you can just fucking tell, right? Like, do they actually know what they're doing or fucking not? As soon as they start saying some like illogical shit about this stuff, it's like a huge red flag, right? No hiding it. No hiding it. I won't be surprised if she makes more from her YouTube channel than actually fucking trading. Okay. 30-minute candle in 6 minutes. Okay. Okay, probably gonna do juice boxing out here, honestly. Started a bit late today, but I'm fucking tired now. But that video drained me, or that was draining right there. God damn. God damn. No, we'll get rid of this for now, yeah. Let's look at some of this data first before anything. Before anything. Because this candle did get most of the liquidity, right? The short that we were talking about yesterday. And clearing out the zone. I'm just seeing like where most of it's at on the downside. So it seems like it's right here. Actual liquidity. Not looking at naked charts, actually looking at actual data. And the next cluster is like right there. Those are the two low time frame hot spots. Boom, boom. Also, where all the high leverage positions hiding out at. This one's quite far away, actually. It's like in this box. Like high leverage liquidations in here. Not a lot, though. Like 30 million worth of like the 100x leverages, like liquidations. You usually want to see a bit higher to consider it a juicy target. So how's the order book looking? Interesting. But the people like the walls that we were talking about yesterday, it was like 85, 84, 83, 82, 81, so on to 79, right? The one at 83 got pulled and they put it at 86 now, but the rest remained the same. So it looks like they might want to try and hold this zone. We'll keep that in mind. Really not much has changed from yesterday though, right? Not much has changed, to be honest. Also, we're the last 2 days for the VWAP, out of curiosity. Same spot. Same spot. Looking pretty sus in terms of the monthly rate. Interesting. How are all the CBDs looking? This might be one of those juice boxes where like if you weren't here for it yesterday to like get into like the earlier longs that we talked about, it might not be like a very good opportunity until these like lower levels, or reclaim some of this higher stuff from yesterday. Same with a short, right? Like this kind of short that we were talking about yesterday up here. Same kind of story. Because you're not gonna have much to work with on these lower time frames in terms of like the oscillators and whatnot, right? Maybe you can weasel your way in on like a super low time frame, like 1 to 3 minute kind of sweep and go. Not particularly reliable entry. I'm just seeing where the rest of these shorts are, because we talked about this hard to stream. Most have closed, but there are still like a decent amount left on like this candle at the weekly open up here, like in this region. A lot of them stayed open from this, and it either stops like right there on that kind of wick, or they put it like here. There's still a decent amount left on Bybit and on Binance. In terms of the CBDs, though,
Top shelf, man. Mid-trade elevation. Marcos.
I'm looking particularly hot.
I'm trading high. Top shelf lit. Man so clean, can't fake this hit. You still stressing, I don't twitch. Just mark that zone and let it rip. Yeah, I'm trading high. Smoke that field. Green turn red, I just stay still. They beg hope, I trust that skill. You want vibe, won't skill. Top flow mode, I fade with grace.
Let's look at some of this options data real quick too. Never even opened it.
Smoking loud, why they panic? Chart look wild, I move mechanic. They want moon, I want range. You want fame, I want change. TP hit, I sip my win. You press buttons, I press within. They caught wick, I caught edge. They caught noise, I caught ledge. I'm trading high, top shelf lit. Math so clean, can't fake this hit. You still stressing, I don't twitch, just mark that zone, then let it rip. Yeah, I'm trading high, smoke that field. Screen turn red, I just stay still. They beg hope, I stack skill. Pull up slow in that man.
Oops. Whoops.
I pull back, I weigh that shell. You gamble blind, I plot and dwell. Candle spike, they think that run. I see trap, they see fun. I hit TP clean, no mess. Mapping tight, I don't guess. You caught
6,800.
you hit size, I hit tone. You want hype, I want plan. You want fast, I want stand. Map in my hand, loud in the air.
Interesting.
Crowd just clear. I don't need flash, just fair. I don't need hope, just stay.
6690. 69. 669. And the flip is 6825. Interesting. This would be a pretty important zone to get above tomorrow if we want to see more upside. If we start to like stall out here, then this is starting to look a lot more realistic. I mean, like obviously, kind of given the nature of the chart, but like the GAX flips up here, also like a huge gamma strikes up here too. So if we do get above it, like pretty bullish, right? If we start to like change structure up here and start to go above this moving average. Interesting. Also, it would be the completion of this whole rotation we were talking about, right? In terms of the math. The next question is like the zone.
Price pull back like I text them, missed ya. I stay high, but the math stay sharp. Top floor trades while you lost in charts. One touch move, yeah, bend that arc.
Okay. Okay. We are caught up on the data. Let's yap a little bit about this stuff, right? Potential longs.
Still locked in when I'm off that pine. She asked what strain, I said precision. She left and Price made its decision. No fear, no fumble, just rhythm and data. Ops get loud, just move greater. TP tap while they still pray. I'm too high to guess, but I never sway. Floating through.
It's not gonna be the most juicy ones, right? Not gonna be the most juicy opportunities here, to be honest. It's like realistically, you'd be looking for like a sweep of this, most likely. Like maybe the spot wall holds here. But at that point, it's looking pretty sus, right? Given all the stuff we talked about yesterday of like closing out most of these shorts, like how much do we end up clearing out of that? Let's just do a fib retracement on the open interest, right? Yeah, like almost 80% of the shorts that opened on this move down got closed out with this move. Like they either took profit or they just got their stops tagged. And like the next major liquidity cluster is this one. Like this one has only grown at this point. And this is also where the high leverage liquidations are to the upside. And like we're already like losing some momentum here, right? Like we're already breaking down on like the RSI and etc. And like we're not gonna have any hidden bull divs on this kind of move down. Like sure, you might start to get some like regular ones on the low time frames here once it starts to get to like the lower levels. Like realistically, you're probably gonna be like, looking somewhere in this zone, right? Most likely, which is like the second of the two liquidations. Like this kind of region-ish, the yellow line. But I don't know if we'd be too trusting of that, right? I don't know if we'd be too trusting, especially if these start to roll over as well. Also, in terms of the math, like the whole concept of like bouncing at this level and then like, retesting it usually starts to just blow through, right? The only context to be aware of here is all the spot orders. They're still here. Most of them are still here. So there is just a world where we double bottom this, which is like pretty uncommon, but it is in the cards. Keep that in mind. Keep that in your brain. I'm thinking there's a world where we bounce here and go, right? Kind of thing. It'd have to be like, if you take this, it'd have to be like super order flow driven, right? In terms of like aggressive buying right now, we're just not really seeing too many signs of it. So it'd have to be like in the moment with like a 1 minute type of scalp entry. So wouldn't be too keen on that personally. Your best bet's going to be a continuation from yesterday when we were talking about flipping the zone from like this fib. Same story, to be honest, right? Nothing has changed in this regard. If you don't get in from lower, it's going to be that. We'll kind of just put like the bullish retest of 87.7 level. And everything that we talked about yesterday about this like still applies. Nothing's really changed in terms of like all the other context. And these two, I don't know. I don't know if I'm feeling these two too much. It's these orders in the spot order book. That's the only thing that's like, normally if these orders weren't in the spot order book, I would say 100% wait for lower, right? Like they can just ignore this shit. But given that like these walls are here, there is a world where we take these and go. But I'd be like pretty cautious with this. I wouldn't, if I was taking this, I wouldn't be putting a lot of size in it. I'd be putting my stop loss break even immediately on the bounce. And if you get stopped out when it goes, then get back in later up here kind of thing. Or like when we reclaim the VWAP. So we'll kind of leave that context, right? Like the 2 low time frame liquidations below. Yeah, be a little suspicious, right? A little suspicious. And then everything else we've already talked about, right? All the lower levels, the high time frame plans haven't changed. So all this downside stuff that we've been talking about, been planning for, same shit. No diff. And that's the other thing about this too, right? Is that right now we're like at the Valley area low. And plus for all the people that were watching this kind of like trend line. Essentially we just back tested and failed, potentially. We don't know yet, this candle hasn't confirmed, but potentially losing the Valley area low after like a bearish retest of the trend line, blah blah blah. Not looking hot, right? We've kind of been talking about this whole move. It's not been looking particularly hot for various reasons. But it's also kind of hard to give much weighting to what the price action visually looks like here, given the time of year we're in. It's like a low volume Christmas environment. So price action can be a bit deceiving in that regard. Like one high volume day can undo like half of the price action in either direction. For the shorts, tricky. Because we talked about this yesterday, right? And if you had taken this, depending on how you manage risk, you still be in it. Like whether you like, okay, there's a few worlds where this could have played out, right? You either got this and put your stop break even, then got stopped out here, or you got in on the move here, shaved some when we got towards like the low and the VWAP, and then you could have put your stop back here and you still be in it. So it's like a little bit late, especially because you also miss like the initial breakdown. And now you're kind of chasing it in a world where we might bounce here or here. So risk reward not very great. Boom. And like the spot order book makes it a bit suspicious, because if this does end up holding, then like, and you try and get into one of these kind of moves, like a bearish retest of the Valley area low, for example, like the VWAP would be coming in after this initial liquidity grab, and then like we do the move to finish up the second one. There's a world where you don't get this second leg, and you just get like blown through, and it reclaims it and goes, and then you're doing like a failed auction at the Valley area low, right? So you're trying to like weasel your way into a short at this point. And in terms of like the low time frame CVD oscillator edge, the same kind of story as the long. You're not really gonna have too much going on here. But probably gonna be something like this, so realistically, right? Like some backtest of the VWAP or one of these like key levels before grabbing like these liquidity boxes. Just keep in mind what's going on here in the spot book. We'll just say like a bearish or retest of the daily VWAP slash PD val. Because also the VWAP for the last 2 days is coming in here too, right? I just delete it. Like this blue one we had on earlier. Like we just lost that. And the one from the day before is there too. So a little late for this, for me. Lower this a bit. And also in the world where we come sweep this stuff, probably gonna be the next one. Like, suppose we start to drift down towards like the New York Session Open, and these things are like starting to roll over as well, like all the indexes. Actually, how's the gap looking here, by the way? Before we continue ranting. Yeah, we have a pretty big RTH gap below as well. Let's keep that in mind. But yeah, like suppose you start to come down here towards the New York market open, and then we got one of these days. Where was it? Like this thing where like there was a bunch of orders in the spot book and it got fucking plowed through. And the whole idea of going to these lower levels that we were talking about yesterday is like in play, right? At that point, because that's like the last line of defense. If that shit does not hold, lows are probably gonna get taken, most likely. At which point, yeah, like look to get in on any back test, right? Whether it's like the 886, like the golden pocket, or like this liquidity grab into the zone, something like that. And you can probably ride that out to like the lows. Kind of just say a bearish retest of, looks like 85.7. Like anything in this region is fair game, right? Essentially. And these higher levels, we've been talking about these, right? All the potential areas of interest for shorts up here has not changed for like fucking weeks at this point. Like we haven't dragged over these red boxes, but you can just go look up where the liquidity is yourself. These are a bit outdated, so don't like take these to heart. But we have talked about them endlessly. So like the higher time frame plans to the upside haven't changed. That should do it, right? That should do it. No, not the best opportunities right now to be getting into anything, given that we're like in a kind of just ding dong tightening range. So if you didn't get in like or on the retest earlier today for the long or this, it's like a bit awkward at this point. That's how it goes, right? It's just part of trading. And just gotta know when to sit on your hands and show for the better opportunities. Yeah, that should do it, right? Enough to get the juices flowing. Don't trade these blindly as usual, right? Like make sure you're looking at the data along with the price action to see if you actually have edge to take the trade. Not don't. And we are out of here. Also, open interest is ramping up here pretty aggressively for shorts again. Interestingly enough. So they could be potentially setting up like another like baby squeeze to the upside, right? If these shorts keep piling in into the zone, might just like squeeze them all out again and finishing the zone. So we could be mindful of that. But yeah, I'm out here. So quick chat shout out and get going because I'm tired. Boy, I'm tired. Pretty short one today, right? In terms of the chat. I think it was just Lyle, right? I think it was just Lyle. Yeah, shout out to Lyle. Got me munching, talking about enchiladas. Making me jealous as fuck. But yeah, we'll be back tomorrow, usual time. Back on the nerd out. Also, actually, just check the calendar real quick. I don't think there's anything particularly interesting tomorrow, if I remember correctly. We have some FOMC members speaking in the morning. Actually, throughout the day, we have a couple of them speaking, so that's probably worth paying attention to. And in terms of earnings, I don't think there's anything either, right? I think it's just like Micron this week. Yeah, we have Micron after market tomorrow, so potential volatility there. Let's see how the semis react. Yeah, other than that, we're out of here. I'm tired. I'm tired. Later. Later.